Good morning. I'm Tracy Gordon, Vice President of Tax Policy at the Urban Institute and Co-Director and Acting Robert C. Posen Director of the Urban-Brookings Tax Policy Center. It's my pleasure to welcome you to Raising Revenue from Corporations, the sixth in an annual series in which TPC and the University of North Carolina Tax Center bring together top-flight scholars and practitioners in law, economics, and accounting to address the most pressing issues in international and corporate taxation. Before we get started, a few housekeeping notes. We are broadcasting and recording this event. The recording and related materials will be shared after the event and posted online. The speaker biographies are posted there as well. We have enabled live captions, and they can be turned on by clicking the CC button on the bottom right corner of your media player. All participants are muted, but you can send your questions or comments into the Q&A box at any time. We are offering continuing professional education credits for this event. To earn them, you are required to answer the polling questions that will be launched throughout. Your CPE certificate will be sent to the email address that you use for registration. If you would like to join the conversation on Twitter, please use the hashtag #live@urban. And lastly, we are always looking for ways to broaden the conversation on tax and fiscal policy to include the latest issues and to identify solutions. We are especially interested in hearing from more voices representing a variety of perspectives, backgrounds, and experiences. So after today's event, we'll be emailing you a survey, and if there are topics that you think we should consider or speakers that you'd like to see in future events, please let us know by filling out the survey or emailing us at info@taxpolicycenter.org. Now onto our program. We are approaching the one-year mark since the Inflation Reduction Act became law. Among other provisions, the IRA levied a new minimum tax on the profits that large corporations report to their shareholders, and it enacted a new excise tax on stock buybacks for publicly traded US corporations. Even bigger changes are on the horizon globally as the OECD pushes forward with its base erosion and profit shifting plan, pieces of which have already been authorized by the European Union, Japan, and other jurisdictions. As my TPC colleagues have written, many questions remain about who will be affected by these new tax regimes and how they might change corporate and investor behavior. For example, will the new minimum tax be effective in ensuring that profitable corporations pay US corporate income tax? Could it be reformed to make it more effective? Is an alternative approach preferable, such as limiting corporate tax breaks, as many of our panelists have proposed? What is the rationale for imposing an extra tax on the buybacks of corporate shares instead of on dividends? Do share buybacks have adverse economic effects, as some have claimed? And should the tax rate on share repurchases be increased, as President Biden's fiscal 2024 budget proposed? And if so, by how much? Will the OECD G20 overhaul of rules for taxing global multinational corporations be effective in limiting harmful tax competition? How will it affect the competitive positions of US multinational corporations? Is the US tax system close to conformity with the OECD rules? And if not, what changes to the US corporate income tax are needed? And finally, what are the consequences if the US fails to reform its own international tax law? To shed light on these issues, we are fortunate to be joined by a truly excellent set of speakers. The first panel will examine potential effects of the excise tax on corporate share repurchases, and the second will dive into the complex issue of using financial statement income as the corporate tax base. Itai Grinberg, a professor at Georgetown Law, who recently served as Deputy Assistant Secretary for Multilateral Negotiations at the US Treasury Department, will conclude with a keynote address discussing the OECD G20 tax agreement and what it means for global tax reform. And now I'll turn things over to my TPC colleague, Steve Rosenthal, who's moderating the first panel. But first, while Steve comes on, we'll have our poll to get started for today. Many thanks for joining us.
Okay, let's begin. Our first panel is entitled Taxing Returning Capital to Shareholders. We are going to focus on the new buyback excise tax. We are lucky enough to have three great panelists who've devoted a lot of thought to firms' buybacks. Alice Boname of the University of Arizona, John Graham of Duke University, and Daniel Hemmel of NYU. With that, let's start with an overview from Alice. Alice, what is a buyback, and what are the mechanics of a buyback?
Thank you, Steve. Good morning, everyone. Thank you for including me in this important discussion. I want to begin, as Steve asked, with by taking a step back and defining a share buyback, and outlining the implications of share buybacks. Then I will discuss why firms buy back their stock, and I will conclude by highlighting some time trends in these transactions. So to begin, what is a share buyback? In essence, a share buyback is a transaction between a company and its existing shareholders, in which a company pays cash to its shareholders in exchange for stock. The first implication is that the number of shares outstanding will decline. We can also see from an accounting perspective that the company's cash holdings will decline and/or its liabilities will increase depending on how the buyback was financed. And importantly, shareholders' equity will decline proportionally to the buyback because the number of shares outstanding drops. I want to highlight a key takeaway is that theoretically, there should be no change in stock price as a result of the buyback. I believe this is one of the most common misperceptions about buybacks that we hear in the media. Often we think that because the number of shares outstanding declines, the price should rise accordingly. And I would like to just remind us of why that's not true. So using an example of a company that has $100 in assets split 50-50 between debt and equity. Suppose this company has 5 shares outstanding trading at $10 per share. If the company would like to buy back 2 of these shares, so to spend $20 on a share buyback, it can finance this with either cash or with debt. So first, let's look at what happens if the company finances this with cash. Then their cash holdings will decline by $20, making their assets decline by 20. Their liabilities will not change, and their shareholders' equity will therefore drop by $20. We can see that the company now has $30 in shareholders' equity. It has 3 shares outstanding. It started with 5, bought back 2. And so the share price remains stable at $10 per share. If the company instead buys back the stock using debt, then its assets will not change, but the composition of assets will, meaning that liabilities will increase by the amount of the buyback, so $20, and shareholders' equity will fall by the amount of buyback to $30. So again, the company will be left with 3 shares outstanding, and the price will be unchanged at $10 per share.
Alice,
Yes.
one quick question. I see that theoretically, no change in stock price. The firm has fewer assets after a buyback, yet also fewer shares outstanding. But how does a buyback compare to a dividend with an effect on share price?
That's
Will
a
the
great
share price fall there? Because later we're going to ask whether executives are trying to manipulate things.
That's a great question, Steve. So it is true that in relation to a dividend, when a dividend occurs, the stock price will fall by the amount of the dividend, whereas with a share buyback, it would remain stable. So from that perspective, relative to a dividend, buybacks help shares hold their value. But the kind of misconception that I wanted to overcome is that they don't necessarily make a stock price pop just because the number of shares outstanding went down. But it is true that relative to a dividend, they would help a company kind of maintain its current stock price. Thank you. So why do companies engage in these transactions? There are many reasons, but I want to focus on 3 principal reasons that companies buy back their stock. The first one is simply to return cash to shareholders. So as Steve mentioned, an alternative to buying back stock is dividends. We can, for this purpose, think of them as somewhat interchangeable. Theoretically, a company should invest in all available profitable projects that it has on hand, and whatever cash it has left over, it should give back to shareholders. And we normally view this as a good thing to give excess cash back to shareholders for two reasons. The first is that the shareholders can then reallocate this cash throughout the economy. The second is that we generally don't want managers to have too much cash on hand. We talk about agency concerns that we could worry about here. For example, managers may invest in pet projects or empire building, bad acquisitions. These are the concerns we have if a company has too much cash on hand. The second reason a company may buy back stock is to signal good news to the market. We often hear about this in buyback announcements. You may hear the CEO or CFO of the company say, "We believe our stock is the best investment out there." The signal that they're sending is that they believe the current stock price is too low relative to what the insiders, who are privy to inside information, believe the true value of the firm is. The final reason that firms buy back stock is to combat dilution. And this has the effect of boosting earnings per share. We know that buybacks decrease the number of shares outstanding. So if a company, for example, is compensating its employees in stock-based compensation, when this occurs, it may dilute the other owners of the firm. And to combat this dilutive effect, a company may buy back, even on a one-for-one basis, for every share issued, they may buy back some stock there. And as a result, by maintaining a neutral number of shares outstanding, earnings per share would either go up or at least not go down. So I want to close with a few graphs on buyback trends. So this first graph shows the aggregate shareholder payouts in the US in billions of inflation-adjusted dollars from the 70s to today. And to me, there are three key points on this graph. The first one is that if you notice, share buybacks were hardly used at all before the mid-80s. And the reason for this is that share buybacks didn't receive safe harbor until 1982. And so prior to 1982, there was a lot of legal uncertainty around these transactions that was resolved when Rule 10b-18 was instituted in 1982. The second point is I'd like to kind of examine how buybacks have grown in magnitude relative to dividends. So we can see that buybacks surpassed dividends around the turn of the century and have generally outpaced dividends until today. The few exceptions are notable. You can see that during the COVID crisis, during the financial crisis of 2008, 2009, repurchases dipped back down. And I don't want to steal the thunder from John, who's speaking after me, but I believe that the reason this is happening is that companies like to keep dividends stable and investors like dividends to be stable, whereas repurchases are viewed as more flexible. So they are a means of payout that companies can pull back on in a times of crisis. The final point on this graph is just the sheer magnitude of share repurchases. If you look at the most recent numbers on the graph, they're hovering around $1 trillion. Even for net repurchases, so these are repurchases minus share issuances, we're hovering around $900 billion. So the economic magnitude is quite important. Another way of looking at this is thinking about the percentage of firms that engage in each form of buyback. So thinking about kind of payout policy style within a firm. Using the most recent data that we have, and I want to note that 2022 fiscal year is not quite complete, but we can see that only 7% of firms only pay out dividends, compared to 31% that repurchase only. 40% of firms engage in both dividends and repurchases, and then 21% of firms distribute no cash to shareholders through dividends or repurchases. Another takeaway of this graph is just looking at the trends throughout time. So we can see a trend away from only paying out dividends and towards either repurchasing only as a means of distributing cash to shareholders or combining repurchases with dividends. And finally, fewer and fewer firms appear to not pay out anything to shareholders. The last remark I want to make is about how these transactions take place. There's several different types of repurchases. but open market share repurchases are by far the most prevalent means of buying back stock. So looking at repurchase announcements, generally in these announcements, firms will tell us how they plan to buy back stock. And if we just scale by dollar value, open market repurchases closely track the total value of all repurchases, meaning that the vast majority of repurchases occur in this manner. If anyone's interested in interactive versions of these graphs, I'll point you to my websites and these slides will be posted. And with that, I'll turn it back to Steve.
Thanks, Alice. We already are getting Q&As, John, on the question of why firms buy back their stock. Like, what's the relevance of a balance sheet versus the expectation of future profits and how money can best be used. So what's your take, John? Why are firms buying their stocks back? Alice highlighted it's more and more popular these days. What's theory and practice in this area?
Thanks, Steve. Thanks also, Alice, for setting the table here for the further discussion. So I'll talk a little bit about what finance theory says and also about what corporate executives say about share buybacks. I'm not sure I'll answer that specific question immediately, Steve, but we can keep pursuing it as we go. The question from the Q&A. So let's take a step back for a second. A company makes profits. What should they do with their profits? Well, we hope that what finance theory says they should do is they should invest appropriately, research and develop. They should hire people, pay wages. On top of that, they should preserve flexibility, okay? By flexibility, I mean retain some of their profits so that if an unexpected bad thing happens, they have this precautionary use of cash, but also in case a good opportunity comes along, they have the cash and the wherewithal to pursue it. Now, after they've covered all their operating expenses and their flexibility, if they still have profits, what should they do? Well, they should pay it out to their investors, because investors, like, who would invest in a company and buy their stock if they weren't going to eventually get a return from that, okay? Two primary forms, as Alice said, of company returning capital to their investors is through dividends and share repurchases. Here's a fundamental fact about dividends. Dividends are very sticky. They're very inflexible. What do I mean by that? If a company announces a dividend, they're going to increase their dividend, they might get a small little price increase of their stock price. But if they announce they're going to cut their dividend, there's a dramatic stock price reduction, or dramatic relative to the price increase, at least. When Paramount announced their dividend cut last week, 28% reduction in stock price overnight. Of course, there's other bad news mixed up in there, but generally speaking, we think of dividend cuts as bad news, stock price falls. Companies don't like it when their stock price falls. Therefore, they're cautious as they increase dividends, all right? They don't want to increase dividends too much because they don't want to ever have to cut them, all right? Now, all of this is just setting the table to now talk about share repurchases, our focus today. Instead of paying a dividend or increasing their dividend, a company can repurchase shares. Now, from the company's perspective, what the two things they really love about repurchases, or one thing they love about repurchases, another thing that they'll take into consideration, in addition to what Alice pointed out earlier about reasons company buyback, a key one is the flexibility of share repurchases, okay? What I mean by that is if a company reduces their share repurchases from week to week or month to month, or even if they never complete their announced share repurchase program, they rarely experience a negative stock price reaction in place of that. And so, in other words, share repurchases are a way to return money to shareholders without being locked in and being inflexible. So the flexibility of share repurchases is a top benefit. And this, by the way, is one reason that dividends and share repurchases really aren't pure substitutes. They are substitutes to some degree of paying out, but companies greatly value this flexibility of share repurchases.
John,
Yeah.
On that point, is this some form of market failure? Why can't the firm announce, hey, we're going to be aggressive on our dividend distribution policy. We're going to set it a little large now, but we may yet reduce it.
Yeah.
Or conversely, couldn't a firm announce, we're going to start a buyback program, and we expect this to be a regular program and a substitute for dividends that you can count on? why wouldn't the market just believe the firms when they describe what they're doing?
So Steve, when you listen to earnings call, you believe everything the executives are saying, how great everything is. No, people are skeptical is one thing, right? It's not as easy as just saying it on an earnings call or making an announcement. But fundamentally, I know this is going a little on the economic direction. It's just the equilibrium we're in, is that if you cut your dividends, you are penalized. Everybody knows the rules of the game. You don't cut your dividend unless your back is against the wall. And could we get in another equilibrium someday where cutting a dividend's no big deal? Maybe, but we're not there now. It's just sort of the fact is, cut your dividends, you're penalized. Anyway. So hopefully that answered that part of the question. Let me go for the second reason, factor that companies consider, in addition to those Alice mentioned and flexibility, is share repurchases are somewhat tax advantaged relative to dividends. Now, the tax rate is one thing that you pay on capital gains or dividends, but share repurchases, if I'm an investor and a company's repurchasing shares, I don't have to sell my share right now. I can time when I sell the share. I can wait maybe till I'm retired and sell my share when my income's lower and my tax rate would be lower, okay? And so because of that deferral and timing, effectively capital gains rates are lower. In addition, if an investor holds, right now, the tax law is if an investor holds a share until death and passes it down to their heirs, then the tax basis is reset and that capital gain is completely wiped out. So because of these factors, capital gains are effectively taxed at a lower rate, and therefore there's an advantage to investors, and companies will also lean towards repurchases over dividends for this reason. So again, to summarize, flexibility and tax advantage are two key reasons that companies favor repurchases over dividends these days.
John, that's theory, but what about practice? Like, you're well known for your work where you actually ask executives why they made distributions. Do the executives' view of the world align with theory?
The flexibility part, 100%. If you ask companies, what drives your capital structure policy, what drives your payout policy, flexibility is key, and repurchases deliver flexibility. The tax part is a little, maybe that's not quite as widely accepted. It'll show up on the list, but maybe number 5 or something for executives, when we use our CFO survey to ask these questions. So yes, both show up, but certainly the flexibility, big time.
And can you trust the executives to tell us what they're doing? Alice mentioned agency issues. Can they be manipulating their stock price by favoring buybacks over dividends, which might yet reduce their stock price?
Well, I think one of the points Alice was making is that actually share repurchases don't really manipulate the stock price, because it's true that there's fewer shares, but you're taking cash out of the company that could have potentially been used, for positive net present value investment or something, creating value. So you're both reducing future cash flows and earnings shares at the same time. So I guess I'm not really buying in too much to the notion that you can manipulate your stock price. I've put it this way. Here's the way to ask it. If it was that easy, why aren't all companies just repurchasing shares all the time? Why would they ever stop? Because it's so easy to increase my share price. I just buy back more shares, right? I don't think the way it works in equilibrium.
One thing I would signal here is we posted articles from all these esteemed writers. One of the articles is from Professor Hemmel, and he was in his article describing executive options, for instance. And you can imagine if you have an executive as an option coming due, they may prefer to buy back their stock and maintain the price than to pay a dividend distribution.
That is actually a fair price. Okay, I was talking kind of more broadly. If you're narrowing it down to and I don't want to steal Daniel's thunder. I'm sure he can speak to this better than me. But it is true, if you have an option that's not dividend protected and you pay a dividend, the stock price will go down, the option won't adjust, and that might be worse for the executive than the repurchasing of shares. So in other words, repurchasing might benefit the executive. I think that's a reasonable point Daniel can expand on. Now, having said that, one reason that we pay executives in stock and options is to align them with shareholders. So maybe the executive is benefiting somewhat, but if they're also making other decisions that align them with shareholders, then that's not all a bad thing, right? We want them to be aligned with the owners of the firm.
One last question. You say you want the firm and the executives to be aligned with the owners of the firm. Are shareholders the only stakeholders? And have firms always only considered shareholders as the stakeholders, not others like the workers, the community, things of that sort?
Great question. So recently, okay, we've been running a CFO survey for 25 years. We've asked the following question a couple times. Company, do you maximize shareholder value only, or do you care about these other stakeholders? And it used to be a heavy lean towards maximizing shareholder value. Now it's much more balanced lean. In the US, it's like a 60 towards shareholder, 40 towards stakeholder, at least in their answers on a survey question. Who are these stakeholders? As you said, in the US, they're largely customers and employees, okay? In Europe, it might more so include environment and community and such that we would get out of US focused companies. Now, the key question here for I think our discussion today is, does taking care of these other stakeholders, does that cost the company something? Is it just money going out of the company to do something for an external thing to the company that takes money away from shareholders, right? Because if that's not the case, then taking care of employees and customers, well, that's consistent maybe with maximizing shareholder value. But if there are these external things that take money away from the company, then that will reduce the equity price, reduce stock price, and possibly raise the cost of capital for the company, et cetera. So do companies care about other stakeholders? Yes. Does that cost them to do it? Debate is open and research is being done. Some people say yes, some people say no, but let's just say we need to wait and see how the stakeholder shareholder balance works out in the long run.
Well, thanks, John. Daniel, John mentioned taxes, and we're lucky to have one of the country's leading tax experts here. Did John get it right? And what is the new buyback excise tax? And why did Congress go about enacting it?
Great. Thanks so much for having me here. Let me see if I can move our slides forward. I got it. So in the run-up to the Inflation Reduction Act and the passage of the buyback excise tax, lawmakers gave 5 different reasons for doing this. The first, which I'll talk about in more detail, is to achieve dividend buyback tax neutrality so that there's no longer this tax advantage that John talked about of buybacks over dividends. A second purported reason for the excise tax was to encourage corporations to reinvest earnings or to raise wages rather than use that cash for buybacks to shareholders. Now, I'll pause here and say, I know of no microeconomic model in which a corporation responds to a repurchase tax by raising wages, or even one in which it responds by building more factories, but that was one of the reasons given by some of the proponents. A third purpose that Congress had was to discourage buybacks that inflate stock price. And as Alice and John point out, this might have just been a misunderstanding of the way that buybacks affect stock prices, and in particular, a misunderstanding of the way that earnings per share are calculated. It's not the case that you can boost your earnings per share just by buying back lots of stock on the last day of the quarter. The fourth was to discourage insider trading via the corporation. So let's say I'm a biotech CEO and I've got my stage 3 clinical trial results, and I know this drug is working. So one thing that I could do is I could go and buy stock in my company before the results are released and put it in my 4-year-old's trust account. And the problem with that is I'd miss my 4-year-old's 5th birthday because I would be sitting in a federal prison. But by buying back shares, the CEO who doesn't participate in the buyback increases her share of the company, but is much less likely to end up behind bars. Not zero likelihood. Now, a 1% buyback tax is a response to that. It seems less direct than maybe more robust enforcement of insider trading laws in the buyback context, but there we go. Right. And the 5th purpose was to raise revenue. And I think we all agree that the buyback excise tax will raise a chunk of change. So all 5 of these purposes were mentioned explicitly by lawmakers who supported the Inflation Reduction Act and or by experts whose input was solicited by those lawmakers who came and testified before Congress.
Can we pause for a second on this slide, Daniel? First, Alice and John, I want you to take a note as to what you think the best justification for the buyback tax is and the worst. And I'll turn to you in just a moment. Before we get there, Daniel, 2 things. You don't have a 6 explanation, which John was acknowledging from your paper earlier, that not so much insider trading, but executive options, that executives might want to see the strike price be in the money, say, and making a dividend distribution might make their option unprofitable, whereas doing a buyback and maintaining the stock price would yet maintain the value of their option. That's a factor too, isn't it? I think John was even acknowledging that.
I think that's a factor for why there are buybacks. Why we would want an excise tax on that is unclear to me, right? The purpose of stock-based compensation is, as John says, to align the CEO's interest with the shareholders' interests, right? Shareholders, their net worth increases when dividends are paid. So I would think that we would construct dividend-protected stock options for executives consistent with that interest alignment goal. And the reason why a lot of companies don't is because of a technical problem with Section 409A of the Internal Revenue Code, which was this like poorly designed provision passed after Enron as part of the Sarbanes-Oxley Act. So I would think the solution would be to fix 409A to allow dividend protection, not to suddenly put an excise tax on stock buybacks.
Right. So even though buybacks might yet be pernicious in some instances, we can address those problems in other ways. Can I just focus you on your point number 2, the reinvest earnings? When a firm does pay a tax on a buyback distribution, and maybe any form of distribution to that extent, wouldn't we expect the firms to retain more earnings? And just to give Congress some plausibility to their argument, they expected firms with more capital could invest more, and that would lead to worker productivity going up and wages going up. Are they just nuts?
I don't think they're nuts. I mean, Alice and John are here, and I'd like them to chime in, but the new view of dividend taxation, which would also be the new view of buyback excise taxation, and it's not that new. I think it goes back to Mervyn King's work from the 1970s, suggests that the tax on distributions does not affect the corporation's decision whether to retain or distribute earnings. Ultimately, what matters is the differential between the corporation's income tax rate and the shareholders' income tax rate. And I don't fault Congress for not understanding the new view of dividend taxation. I think you need to get to like your second course in finance before you get that. But they were like 50 years behind if that was their rationale.
Is the new view right, John? I mean, when we lowered the tax on dividends in the early 2000s, were there a whole bunch more dividends paid or fewer dividends, or was it constant? Like, how did the new view actually hold up? I think you wrote an article on this point.
I didn't actually write an article on that, but I guess what we could say is in the short run, there were positive stock reactions for kind of heavy dividend paying firms, but it's not clear that in the medium term or long term that it had a long lasting effect. So I don't know how to disentangle some of those short run price reactions we sometimes see from this deeper point I think that Daniel's making.
And Alice, we haven't heard from you for a bit. Like, what's your favorite purpose for the buyback excise tax here? And what's your least favorite? And then we'll let Daniel move on.
Well, I think Daniel raises really good points. I love this outline here. I think the buyback tax could possibly help with number 1 and dividend buyback tax neutrality, and number 5 for sure, right? Number 5 is the one I'm most convinced about. My estimates are that this will raise about $8 billion in revenue per year. Number 1, I think I agree with Daniel's point, which is that on all of these, we kind of need to figure out what problem we're trying to fix. And as Daniel and John have both pointed out, I think a lot of the issue with the tax neutrality is about the timing of the taxes. And something that we haven't talked about yet is also that when someone passes away, their heirs get a step up in their tax basis. And so maybe if that's the broad concern here, maybe we need policy that goes more directly to that problem, as opposed to this excise tax on buybacks. And in terms of the number 2, 3, and 4, I would say that especially number 2, there's very scarce evidence that taxing distributions would increase investment. We definitely need more research on the topic, and it's a hard test to structure, but especially because the companies that tend to pay out the most tend to be at a stage in their life cycle when maybe they have the least investments. So it may look like these things are negatively correlated, when in fact it just may be that these are older firms that have kind of run through their investments and are now paying out extra cash to shareholders.
Thank you. Thanks for your patience, Daniel. Keep moving here.
I'll pick up on this dividend buyback tax neutrality point. There are 4 major types of shareholders of U.S. corporations: U.S. individuals, and U.S. individuals generally, for reasons that John explained, prefer that corporations return cash to shareholders via buybacks rather than dividends. Buybacks and dividends are taxed at the same rate, but with a buyback, you can not participate in the buyback and then only cash out either when you're in a lower bracket in retirement, or better yet, after you die. Second group, and this, according to Steve's work, is about 30% of the shareholder base of publicly traded U.S. corporations. So non-U.S. persons, foreigners, they really prefer buybacks over dividends, because on dividends, the U.S. charges a withholding tax. And that, if you're in a non-treaty jurisdiction, if you're in the Cayman Islands, that's a 30% withholding tax. Whereas we don't tax capital gains to foreigners on portfolio investment in the United States. And I think probably most of the tax advantage to buybacks over dividends is really that group. Third, corporations that own as portfolio stock shares of other corporations. So this is like Berkshire Hathaway. They possibly have a preference for dividends because they have a lower tax rate on dividends by virtue of the dividends received deduction than on buybacks. But this is a relatively small portion of the shareholder base, and it's hard to believe that they're driving policy here. And lastly, 40% of U.S. stock, according to Steve's estimates, are held by tax exempts or investors who have the same incentives as tax exempts, defined pension plans, individuals in traditional IRAs or 401ks. And they don't care about dividends versus buybacks, at least in a pre-Inflation Reduction Act world.
So Daniel, John's description of taxes focused on your first category, U.S. taxable individuals, not your next 2. Or 3, I guess, are here. Have these categories shifted over time? Is one factor more important now than earlier? Could that yet explain more buybacks?
Well, we have the world's leading expert on this particular subject moderating this panel, so I'll kick it back to him in a moment. But yeah, number 2, non-U.S. persons, their share of U.S. publicly traded stock has increased significantly in recent years. And U.S. individuals in taxable accounts, I think, according to Steve's estimate, that's like a quarter of the shareholder base of publicly traded corporations now.
Yeah, I think all that's right. I mean, historically, economists and financial analysts have focused on the domestic and not the international aspects of our economy. And our economy has really shifted to be much more global. And that influences a whole bunch of stuff, I think, both as you and I have explored. But why don't you go on, Daniel? Who's winning and who's losing?
Right. I want to make 2 normative claims here. So what's the matter with buybacks? There's this non-neutrality, but why does that mean that the taxation of dividends is normatively better than the taxation of buybacks? We could just change the taxation of dividends so that it's more like the way that we now treat buybacks. The first problem with the pre-IRA treatment of buybacks is what Greg Polsky at University of Georgia and I have called the Mark Zuckerberg problem. So entrepreneurs form corporations. They generate billions of dollars in what's essentially returns to labor. Right? It's not that Mark Zuckerberg put a lot of cash into Facebook. He just put a lot of human capital into Facebook. Facebook then returns cash to shareholders exclusively via buyback. Facebook has never paid a dividend. And Mark Zuckerberg pays no shareholder level tax because he won't sell his shares until he dies. If he needs liquidity before then, he'll just borrow against his appreciated stock, right? So we could have a good debate about whether the optimal tax system would or wouldn't tax capital income, but I think we all agree that we should be taxing labor income. And the current tax treatment of buybacks has led to the non-taxation of a particular type of entrepreneurial labor. The second problem is what Professor Polsky and I have called the Panama Papers problem. So foreigners stash funds in tax haven accounts, but they don't actually want to leave their money in, say, Panama or Jersey. Jersey as in the island off the coast of the UK rather than the state one below mine. So they invest in US stocks. They pay no US withholding tax as long as they receive no dividends, as long as they invest in companies like Tesla, Amazon, Facebook that return cash to shareholders via buybacks. And then they pay no tax in their haven country because that country usually has a zero tax rate. And their home country tax authorities don't know about it, right? So because our biggest companies return cash to shareholders via buybacks rather than dividends, we've become this ultimate tax haven. We are where the money goes after it stops over in Jersey or Isle of Man or Panama. And we might think there's a problem with that too. So how would we neutralize the tax advantage of buybacks? Well, one option would be to just treat buybacks like dividends. If a corporation with 100 outstanding shares buys back 10 shares for $1 per share, the remaining shareholders would be taxed as if they'd received a dividend of 10 cents per share and then would have their basis increased by 10 cents per share. This was an idea proposed by Martin Churlstein, the Yale law professor, in a 1969 article. There's some complications with this. One is that some shareholders would owe the tax even if they hadn't received the cash. The shareholders who don't participate in the buyback would be taxed as if they'd received a dividend. I'm not sure if that's really a problem in the world of E-Trade and Fidelity on your phone, where you can just easily generate liquidity by selling your shares, but that will certainly rub some people the wrong way. Second, the arrangement with the necessary basis adjustments would be difficult to explain to retail investors. It doesn't really matter because their brokers could track their basis and tell them what their tax obligations are, but like trying to explain this to an ordinary American is not easy. I know from trying to explain it to very smart law students. And third, I think this was the killer. It's very hard to implement without violating President Biden's pledge not to raise taxes on anyone making less than $400,000 a year, because there are some people making less than $400,000 a year who own stock in companies that buy back shares, and this would raise taxes on them. So option two is an excise tax. With an excise tax on stock buybacks, either corporations will pay the excise tax, and then the US will collect some excise tax revenue from the Mark Zuckerbergs and the Panama Papers account holders, not directly from them, but from the corporations that distribute cash to them. Or corporations will just shift from buybacks to returning cash via dividends, and then the US will collect money via dividend taxation. It's really easy to administer, and because the tax is only ever imposed on the corporation, there's no problem with President Biden's $400,000 pledge. And I think this is really the reason why Congress settled upon option two. Now I'll make one last point and then kick it back to discussion. The distributional implications of the buyback excise tax are complicated. In a broad sense, the tax is being paid by corporations. Shareholders of corporations tend to be pretty rich. We're using this to fund climate investments, which benefit the whole world. From a progressive perspective, we should be happy about this. But with a 1% excise tax, some publicly traded corporations will continue to return cash to shareholders via buybacks rather than dividends. And when that happens, the tax-exempt shareholders shoulder some of the tax burden. whereas they wouldn't bear any of the burden of dividend taxation, right? When a corporation returns cash to shareholders via dividends, tax exempts don't pay anything. If the excise tax rate were high enough that no one bought back shares, that they always returned cash to shareholders via dividends, then the burden on U.S. individuals, right, would be and U.S. And non-U.S. Persons, they would bear the burden of the dividend tax, but tax exempts would bear no burden at all, right? So the tax exempts should want the excise tax to go from 1% to infinity, because at infinity, then corporations return cash to shareholders via dividends and the tax exempts are immune. But a 1% excise tax ends up redistributing away from the tax exempts, who might be the people who we actually want to hold harmless.
Well, let's shift to some of the other panelists to react to some of Daniel's assertions. I guess the last one was pretty provocative. Maybe we should set increase the buyback tax from 1% to infinity and get rid of buybacks. Alice, John, what do you think of that?
I'll chime in with a few points. Thank you, Daniel, for laying everything out so clearly. One of my takeaways from Daniel's points is that the problem seems to be maybe less about buybacks and more about the way that capital gains are taxed in the US. And so somewhat related to Daniel's point about thinking about buybacks as dividends and sharing the tax burden among all shareholders and immediately, an alternative to that is taxing everyone on capital gains each year, right? Almost like a mark-to-market basis where we can calculate, especially on a publicly traded stock, what everyone's capital gains are that year, whether they're realized or not. So, perhaps an alternative that gets at what Daniel was trying to get at is, how about every year we just all calculate our capital gains and losses and pay taxes mark to market? Of course, some issues that I see with that, it's quite easy on a publicly traded company. It's much harder on illiquid assets and within private firms. So I'm not sure how that would be implemented. But I think my broad takeaway is maybe the repurchase excise tax still seems to be a roundabout way of getting at these real problems that Daniel identified, right? The Zuckerberg problem and the Panama Papers problem. And it seems like perhaps there's more direct tax policies that could be implemented to provide solutions to these issues.
Thanks, Alice. One reaction that I have, it's true, like in dimensions that Daniel talked about, what he said made sense. Let's shift back to one other dimension, which is this flexibility thing, right? It's the fundamental thing that companies seek to preserve so that they can handle both the upside and the downside. And repurchases deliver that. So if we somehow eliminated them, if we still stayed in this equilibrium that you don't cut your dividend, then either we're going to have companies just stockpiling cash as their way to have flexibility, or they're going to have these negative price reactions if they pay dividends. Do we really want companies to stockpile a lot of cash, right? There's some people, we didn't talk about it much yet, right? But because the economists I don't think of it this much way as much as the politicians do. But a frequently cited explanation for these excise taxes on repurchases is because companies don't invest enough. We'll force them to hold on to more cash, and then somehow they'll invest. I think maybe Alice touched on this a little bit earlier. I'll come back to that in a second. But if they're stockpiling cash because there's no repurchases, then it's okay. What some research shows is that the worst evil would be companies having too much cash and being kind of inefficient with their cash. Some people I saw in the Q&A, you might earn a low return on it. That's true, but then your risk and return go together. That's not necessarily all bad, but wasting cash can be a really bad thing and getting really sloppy. So there's a discipline element of getting companies to pay out, whether it be dividends or repurchases, that killing the repurchases, taking away flexibility, forcing them to hold cash, discipline might go out the window. Long-winded way of saying there can be unintended consequences to eliminating repurchases, I think. One other side point, when we talk about, and this is a little bit of a semantics thing, I guess, but if companies pay a large excise tax, it's 1% now, President Biden proposed 4%. stock prices will go down, right? Because that's less money in the company. Any entity that holds stocks, including the pension that pays public school teachers, they will suffer a loss. Even though they're tax-free, they effectively pay that tax through a lower stock price. And so technically, but at some level, there's no way to say, we're not harming people who make less than 400,000 with some of these taxes, because if stock prices fall, they will at least indirectly get harmed. Thanks.
So Steve and I had discussions in early 2021 with some policymakers who were thinking about capital tax reform. And I initially had the same impression that Alice had, which is there's no way the best solution to this problem is an excise tax on stock buybacks. Do something more direct, like a mark-to-market tax, or just like change the treatment of basis at death, or like tax the dividends to foreigner, or tax the buybacks insofar as they're benefiting the foreigners in the Panama Papers accounts. And then like pretty quickly, we ran into problems with all of these. So if you do anything that's specific to foreigners, you tear up every tax treaty. And then you've got foreign relations consequences for US multinationals with investments overseas. Like you don't want to do that. You could just shift to a mark-to-market tax, but then we get into the problem of what to do about non-publicly traded assets. Are we really going to give Elon Musk a big tax refund in 2022 when his mark-to-market net worth goes down hugely? And mark-to-market polls terribly, right? And stepped up base or changing the taxing people at death does not poll very well either. You get Christine Noem going on Fox News talking about death taxes. And we try to say, no, we're not taxing death, but like we kind of are. So the buyback excise tax ended up, I think, looking like the least bad, or at least the most politically plausible of all of these options, particularly in a 50-vote Senate. On John's point about flexibility, I have to imagine that if we went back to a pre-1982 world, or a Hamel world where we have an infinity tax rate on buybacks and just no one does that, then the sociology of corporations returning cash to shareholders would change. And when you declared a special dividend, people would understand, you're not committing to do that going forward. And then when you declared a normal dividend, people would kind of assume that that was a locked-in expectation.
That's a fair point. The special dividends, which we haven't talked about, many people may know, but in case you don't, it would be an occasional dividend that you're not really committed to continue paying each quarter. So if repurchases were eliminated, I agree, Daniel. I think that special dividends would start playing a bigger role. And okay. One difference between dividends and repurchase: when you pay a dividend, every shareholder receives it. Okay, repurchases, only the people who sell their shares receive it. So that anyway, that is one difference. They're not perfect substitutes, special dividends and repurchases. But it is another advantage, by the way, of repurchases, is as an investor, I can decide when I want to sell my shares instead of just getting a check in the mail and being forced to pay tax this year, which could be a bad year. And by the way, that's also why I think the mark-to-market is a big challenging issue, because young people who they're doing what they always heard they should do, they're buying stock, and now they don't have a lot of liquidity, right? And they're taking that last dollar they have to buy a share of stock, and then they're told, hey, you've got a tax this year. Oh, I have to sell my shares to pay the tax. I was trying to save for retirement, So there's a liquidity issue on paying those yearly taxes that could come with a mark-to-market.
To be clear, I was not advocating for it. I was making just a parallel in Daniel's argument. Right.
Sure.
So, yeah.
It's a good point. It's a good point. The step up
And
in
I think we
basis
should do mark-to-market, but I just realized that it's a very heavy political lift.
Yes.
That's a different panel. But John, you described the advantages to shareholders of selecting when they sell. Is that an advantage to the rest of us and to the US fisc, or to efficient allocation of capital? I mean, why do we care to lower taxes on shareholders? I would have thought the threshold question is capital better outside the firm or inside the firm? And so why do we care to allow shareholder flexibility on their taxes?
If it's all a tax game, that's a fair point. That if all shareholders are doing is avoiding taxes, that doesn't sound like a collective good. But we also have ebbs and flows. You know, my kid's going to college. I need some money. I'll wait and sell my shares then, rather than being forced to pay taxes every year until then, or some such thing. So part of that is just optimizing my own utility function by selling shares when I need more liquidity at that time, and not effectively selling them every year by paying a tax every year. That's kind of the point I was trying to make.
So let's go to the actual tax Congress enacted, the 1% tax. Have we seen anything? Any results? Would we expect to see any results? Any change in firm behavior? What do you think?
I'll just throw one out there. From what I've been able to tell, haven't done like a rigorous study on this. It doesn't seem like a 1% tax has changed corporate behavior very much. In that sense, it might be a win because there's revenue collection and yet not much distortion of corporate behavior. Although there could be, again, that reduction in stock price that does have a little bit of an offset to the revenue reduction. If we went up to the 4% tax that President Biden proposed, my understanding is that might not even collect more revenue than what we're collecting now. And that could potentially start, I would expect it to actually to distort taxes. Sorry, I'm talking so much because I said I'd be short, but one last little side point here. The excise tax is on every dollar repurchase, right? All these investor taxes we're talking about, it's only on the capital gain, when an investor sells their shares. So a 4% excise tax is like a much higher capital gains tax in terms of the all-in tax consequences, which maybe that's good. I don't know at some level if you're collecting revenue, but in terms of thinking of distortions and taking money out of the system in other ways, it could be a big number.
I agree with John's points. And I think we've touched on kind of my list of how I think firms may change their behavior if this tax gets high enough, repurchasing less, paying more regular dividends, possibly more special dividends, possibly hoarding cash. One other kind of unintended consequence that this could happen if firms start repurchasing a lot less that we haven't mentioned is that repurchases do help with liquidity and they help decrease stock price volatility. And we generally think of it as being a good thing to have a liquid market and a less volatile market. So if firms were to completely stop repurchasing, we may expect to see kind of less liquidity and more volatility in the market, which could be troublesome.
So I'm going to disagree with the idea that going up to 4% would be revenue reducing, would put us on the wrong side of the Laffer curve. I don't think we'd raise much revenue from the excise tax, but we'd raise a ton of revenue from corporations shifting their distributions from buybacks to dividends. And I think on net, we'd still be raising revenue because the effective tax rate all in on distributions via the dividend channel is higher than 4%. I think there's a consensus on that point, including Steve's estimates and updated estimates from the Penn Warden budget model. One thing that I did not anticipate about how this would play out in practice is just how hard it is to define a buyback. Like we kind of know what we're talking about here, but then writing a statute that captures what we want to capture and doesn't accidentally tax some things that were not relevant to Congress's core concerns is really hard. And Congress basically punted to Treasury on this point, but it remains a really hard problem for Treasury as well. So there's been a lot of uncertainty in the SPAC market about whether SPAC liquidation will count as a buyback for excise tax purposes, which could be a real problem because the SPACs are obligated to give everything back. And there's like no accounting for the excise tax in their corporate documents. So Treasury tried to write a carve out that would address that. But I'd say at least the New York tax law community is divided as to whether the carve out really works.
Well, carrying on the current tax, and maybe Daniel, I'm sure will have views, as I suspect Alice and John will also, but Daniel's views will probably be longer. So maybe I give Alice and John a crack first. Like, what could Congress do to improve the buyback tax, either the base or the rate? And then I'll shift to Daniel. We've already heard Daniel suggest he'd like to go to infinity, but if we're looking to make more money, maybe we go to 4%. But John, Alice, what do you think? Is there any redeeming value to the buyback tax, and can we reform it to be even better?
Go
John,
ahead.
Okay, all right. Well, I'm learning as I'm here. I think Daniel and I could maybe continue our discussion offline, but I think to me, it boils down to what the purpose of the tax is. And one of the stated purposes of the tax that we haven't really covered is whether we should be disincentivizing repurchases. And I think that a lot of hate is thrown at repurchases because there's a story that they can be used to manipulate stock price so that insiders can dump their shares at an elevated price. And then this destroys value for the other shareholders as well as maybe for employees and other stakeholders. And so in my opinion, I think that there's not research to back up this story. I don't think we should be disincentivizing repurchases. There's very little evidence that repurchases can be used to manipulate price or are manipulating price. The evidence that insider trading tends to happen with repurchases has kind of been debunked recently by showing that this is just based on the corporate calendar and when blackout windows in. So both the firms and insiders trade at once. And then there's really no evidence that repurchases kind of destroy long-term shareholder value. If anything, repurchasing firms tend to outperform other firms. And so I think, my only takeaway would be we want to be a little bit careful about disincentivizing these transactions that can have benefits for firms, including the ones we've mentioned today, of distributing excess cash, getting that out of the hands of managers, and maybe improving liquidity and decreasing volatility. So I would maybe tread, I don't have a specific answer for you, Steve, but to tread lightly and increasing could have some unintended consequences.
Well, Daniel, John, did you want to say something here?
I cede my time to Daniel.
Oh,
Daniel, we've heard your view on rates, pretty straightforward, infinity or 4. How about base? Anything we can do to make the tax broader?
Yeah, I think I've got two objections to the base, or two places where I think a broader tax could be helpful. One is Congress excluded private companies from the base, and we've got some pretty large private C corporations, and we will have more if being publicly traded means that you can no longer return cash to shareholders and have your entrepreneurs and your foreign investors avoid US tax. And then the other, and this takes a little more thought, is the original buyback excise tax proposal from Bill Andrews, who was a Harvard law professor in the early 1980s, included cash acquisitions in the base. And he would have said, though he would have had no idea what Microsoft or Activision Blizzard meant when he was writing in the early 1980s, that when Microsoft buys Activision Blizzard in an all-cash deal, that's returning cash to shareholders. The foreigners who invested in Activision Blizzard from their Panama Papers accounts, they're getting cap gains, which aren't taxed in the US. So if the goal is to have the excise tax capture that money that's leaking out of the system through the Panama Papers channel, then we should apply it to cash acquisitions too. Microsoft and Activision Blizzard, Amazon and Whole Foods, and so on.
Well, let's turn to Q&As from the audience. For those in the audience, I've been watching these Q&As come in. I'm going to synthesize a few of them. And for those who want to start adding more now, great. I apologize if I miss any. And by the way, I'm going to throw these out to our panelists, but I'm going to also ask our panelists, some of the Q&As were directed to sort of like technical points made by one panelist or the other. And so you can volunteer to answer a question you might like to answer, or somehow work it into the answers to the questions that I present. But let's start with, our audience is dismayed by the poor policy choices, revenue choices that Congress ends up with. Did the politics really constrain things so much? Why don't we have a mark-to-market or a wealth tax? Any of you want to be political prognosticators here? I think I called Daniel who's
The
most
US
comfortable
Senate,
with that.
right? There were not 50 votes for a mark-to-market tax or a wealth tax. And part of the brilliance of the 1% excise tax is no one could get all that worked up about a 1% excise tax. I mean, it seems like from John's comments, even CFOs and CEOs aren't all that worked up about a 1% excise tax. So yeah, I think the politics do explain this. The one thing that I would add is with a wealth tax, and maybe even with a mark-to-market income tax, you do have the question of whether there are 5 votes on the Supreme Court to uphold it. And with a wealth tax, my bet is there are not 5. I'm not sure if there are even 3 votes on the Supreme Court to uphold it. With a mark-to-market income tax, it's a little bit closer. A buyback excise tax raises absolutely no constitutional concerns.
So how about a question economists are more comfortable, tax incidence? Got a couple questions on those from our audience. Who won and who lost with a buyback tax? John, Alice, would you like to tackle that?
I'll start, I guess. I guess who won is, again, it's a small number, so everything's in small magnitudes here, but I guess more revenue is collected, that's a win. If good things are done with that government tax collection for climate or something, that's a win. On the who lost, I guess that would be companies that repurchased a lot of shares typically, even maybe for good reasons. And anybody who owns share stock whose price went down lost at least a little bit in that sense.
I agree with John's assessment, and I'll even put some numbers around it. Some preliminary analysis that I've run looks at returns to stocks on the day that the Inflation Reduction Act became more clear. So this is when Cinema agreed to vote for it on August 5th. And if we divide the sample of publicly traded US companies based on their buyback activity, we find that companies that historically had bought back a lot of shares went down in value about 0.5% to a percentage point more than companies that were not buying back stock. So somewhere in the range of, call it 75 basis points in market value was lost on companies that were repurchasing versus not.
So we have some eagle-eyed audience members studying your charts, Alice. They observed, or at least one person observed, that buybacks really seemed to take off in the 2000s. I think you pointed out that the regulatory regime may have changed, I think, in the 80s. But why did things take off in the new millennium? What's that all about? Do you have any thoughts, clues as to why are buybacks more popular now than they were before?
This is a great question. It may have to do with some of the compensation issues that were brought up. So if employees are being compensated more in stock-based compensation, then because of the dilutive impacts of this, we may expect more buybacks as well. It can also do with the composition of publicly traded firms in the US. We have now kind of our companies are getting older and more mature and more at a stage in the life cycle where they are able to distribute cash to shareholders. And the kind of new generation of old firms is choosing buybacks over dividends because of some of the reasons that John mentioned about dividends representing such a commitment and being sticky. John may have some other insights as well.
The only thing I'll add to that is this is aggregate repurchases on Alice's chart. And there's some hugely profitable companies doing the bulk of the repurchases. So just corporate profits went up also. And, I'm going to think that's a good thing, right? And then they pay out they pay out these profits to their investors. But anyway, the part of it too is just profitability as companies matured, as Alice pointed out, increased a lot since 2000.
So let me ask one more question, and I want each of our panelists, to the extent they have something to say at the end, to make a summary point and or answer a question from the Q&A they thought resonated with them, either was insightful or just wrong, as Alice is wont to tell people here about expectations for the buyback tax. A lot of questions on, hey, with a buyback tax, isn't there more retained capital? And some thought that was good, maybe there'd be more money to invest in R&D, And one of our commentators said, well, that could be bad if this is an oil and gas firm that may retain more earnings and pollute the environment more. What do we think about this notion of buyback taxes lead to more retained earnings? And is this a good or bad thing?
I think they would lead probably to more retained earnings. And I'm not sure it's a good thing because some companies don't effectively use their cash. But let me just give a slightly bigger, and this give me my concluding comment too, Steve, which is by forcing companies somehow to have more cash and retained earnings, are we going to force them to invest? Now, companies that are not financially constrained probably already invest as much as they feel is optimal. So giving more cash to one of these companies, which are typically, by the way, the same companies that do a lot of repurchases, I'm not sure they're going to do more investment. They're already doing as much as they want. If you have a financially constrained firm, and then somehow they have more cash, they may invest more. They were constrained from being able to fully invest before. But if they're constrained, then why are they paying out in the first place, right? So only if you have this idea, there's some really bad equilibrium out there where financially constrained firms are paying out too much, do I think the tax and forcing them to hold more cash would improve their investment that they would make. So I think it's like pushing the end of a string, as they say, to try to force companies to do something like invest more by kind of forcing them to have more cash. Thank you.
Daniel, any concluding remarks or insights?
Yeah, and I'll switch to headphones. Hopefully I'm still audible because there appears to be some protests going on outside my office in Washington Square Park. I think people are really worked up about the buyback excise tax over here. So insofar as what the tax does is encourage corporations to retain earnings, I agree with John, that's a bad thing. I don't think those retained earnings will go to higher wages. They might go to nicer private jets or board trips to the golf course. And they also might go to buying up other companies. So there's a tension between the progressive view on stock buybacks. Stock buybacks are bad, but also concentration is bad. And if you prevent companies from returning cash to shareholders via buybacks, well, then they might do what Microsoft is doing with Activision Blizzard. Second, I'm not sure, and I'm here with two finance experts, that the effect really will be an increase in retained earnings. I think there's a world in which the buyback excise tax could lead to, and I don't think we've observed this yet, a rational response of more distributions in the medium term. And the reason would be, we saw how easy it was to get this 1% excise tax through. And once we had the 1% excise tax, it's really tempting to dial up 1% to 4%, especially if JCT will score that as a revenue increase. So if I were a CFO, and I were sitting on a pot of earnings, I might be thinking, now is a really good time to distribute earnings to shareholders via buybacks when there's only a 1% excise tax, because post-2025, that might be a 4% tax that I'm facing.
Although so far we have not seen much of a response by firms in terms of changing their behavior. And as John pointed out, usually economists like that, free money, like a poll tax. And so going from 1 to 4, that might also be below the optimal level. And maybe that's more free money for the government without changing any behavior.
I should add, I mean, free money, I'm here with two finance experts, so I'll let them pick up on this. We are increasing the tax on equity capital, right? So we are making, I think we can all acknowledge that we're doing that with a buyback excise tax. There was this tax advantage to equity that we're trying to take away, at least in bits and pieces. And that's going to lead corporations probably to fund themselves more through debt. And that's not free. There are costs to that.
Okay, Alice, you started us off. You get the final word here.
Wow, I didn't know this. Well, first of all, Daniel, there's no such thing as a free lunch now. I think for me, I'm just thinking about what the likely implications are of this excise tax are, especially if it were to increase. And to echo what the other panelist has said, I don't think we will see an increase in investment. I do not believe we will see an increase in employment. I don't believe that there's a real problem to fix in terms of buybacks being nefarious transactions that insiders use to enrich themselves. So I think that, the main purpose of the law will be a wealth transfer from shareholders to the government. And so it boils down to thinking about, is that ultimately a good thing? Remembering that, as John pointed out, the shareholders include the teachers and the firemen, right? But as Daniel pointed out, if this is going to fund long-term investments in the environment, then we need to think about that as well. So these are really hard costs and benefits to measure.
Okay, let me just remind the audience, we have bios for those who want to learn more about our presenters today. We have papers, links to papers from each of these academics. And then we have their PowerPoints posted as well. So those are available. I'd like to thank our panelists for a spirited conversation, framing issues. We are next going to talk about book income as a tax base. Before we get there, I believe we have a poll to run now. And then I will turn it over to Jeff Hoops after the poll. Okay, I think we've given you enough time to answer 3 questions. We appreciate your input. And let me shift over to Jeff Hoops with our next panel.
Thank you, Steve. So thanks for joining us. So we are next going to have a panel that is about including the book income in the tax base. So as many of you know, the Inflation Reduction Act, which was passed last year, includes a major tax provision, which includes book income as part of the tax base. We're going to talk about the provision with 4 excellent panelists. We have with us Pat Brown, who's a partner and co-leader at Washington National Tax Services at PwC. Michelle Hanlon, who's the Howard W. Johnson Professor and Professor of Accounting at the Sloan School of Management at MIT. Danielle Rolfez, the partner in charge at Washington National Tax Office at KPMG. And I am Jeff Hoops, an associate professor here at the Keynote Flagler Business School at UNC and the research director of the University of North Carolina Tax Center. So we're talking about this tax on book income. Michelle, could you just start us off by explaining to us a little bit what this tax on book income is?
Sure. Thanks a lot, Jeff. And thanks to all the organizers for inviting me to be on this panel today. So this corporate alternative minimum tax, or the CAMT as it's being called, this is an alternative minimum tax. And what I thought I'd do is just step back and talk about alternative minimum taxes in general. Basically, with any alternative minimum tax system, what a company will have to do is compute its regular taxable income and regular tax using the tax code specified by Congress. And then also it will compute again on a parallel tax system, this alternative minimum tax. And generally in these alternative minimum tax systems, these parallel tax systems, there's a different tax base and a different tax rate. And if the parallel tax system, the alternative minimum tax system, yields a higher tax, then the company has to pay that higher tax. Really what they'll pay is a regular tax liability in this incremental portion that ends up being the AMT, or the alternative minimum tax. In this case, with the CAMT, as people call it, the alternative tax rate is 15%, and the base is what we're calling adjusted financial statement income. And I'll explain what adjusted financial statement income, or AFSI as it's being called, how that's constructed. But basically the rate is 15% and AFSI is the base. And so if the AFSI times 15%, if that is greater than the regular tax plus the BEAT, then the company will owe some CAMT. And so that's kind of the very basics of this system. It's effective for tax years beginning after December 31st, 2022. So it's already in effect as of now, even though, as we'll cover in this panel, we don't really have all the details yet about the tax. It's actually effective currently. So I think one thing, is important is who does this actually apply to? It applies to what we're calling an applicable corporation. And this, I'm going to extract a lot from details today when I explain this. So this is a high level discussion. But basically, it's a C corporation who has average annual adjusted financial statement income greater than $1 billion over the prior 3 years. If it's a foreign subsidiary or U.S. subsidiary of a foreign parent, then that subsidiary in the U.S. also has to have $100 million of average AFSI over those 3 years. The key thing, I think, with this portion of the rule determining who is an applicable corporation is basically once you're an applicable corporation, you're always an applicable corporation unless Treasury says you're not. So once you're in the CAMT system, you're always in the CAMT system unless you can get out of it and Treasury approves that you're out of it. But basically, it's very large corporations, $1 billion of adjusted financial statement income on average over the prior 3 years. Okay, so how is this AFSI computed? I think kind of at a high level, what's important to recognize when we talk about this AFSI, this adjusted financial statement income, is that it's not equal to taxable income and it's not equal to financial accounting income. It's actually a third set of books. So we're going to start with financial accounting income, but then we're going to make a bunch of adjustments. And I think that's very important to recognize that it's a new definition of income, and it's actually not the same measure of income used in the OECD Pillar 2 minimum tax either. So it's its own kind of creature here. So again, we're going to start with financial statement income of the company that we're talking about, and then we're going to add back federal income taxes and foreign income taxes to get to AFSI. Then also we're going to make some adjustments that kind of get this measure back to a little bit closer to taxable income. In other words, we're going to treat some items like we treat them for tax and some items like we treat them for book. And so one of those items is depreciation. What we're going to do to get to AFSI is kind of remove the depreciation that financial accounting used. And then we're going to subtract the tax depreciation. So depreciation is going to use the tax rules essentially in AFSI. Also, the qualified wireless spectrum, the amortization for that under Section 197, that will be allowed as a subtraction to get to AFSI. And defined benefit plans, basically what we're going to do is treat those like we do for tax. In other words, it's not going to be that accrued expense that we use for financial accounting, which is made of 5 components. What we're going to use is the cash contributions into the defined contribution plan. So we're going to use tax treatment for that item. And that's what I mean. Some of these items are going to be treated as we treat them for book and some as we treat them for tax. Okay, the other thing that's very important to remember when we go through and compute AFSI is that the consolidation rules are different for book than they are for tax. So financial accounting and tax rules are different. So for example, for financial accounting, when we consolidate worldwide entities. And the rule essentially is if the one company controls the other one, and we're going to proxy for that by ownership of greater than 50%, essentially. And again, it doesn't matter if it's foreign or US. Under US GAAP, we're going to consolidate all these entities up. But for tax, basically, the consolidation rules are that we're going to consolidate them. It's an election, and you can consolidate when ownership is 80% or greater. So you can see those are different. So at a very high level here, what we have to do to get to this AFSI, essentially how the rules work, is entities that are not part of the tax consolidated group, the financial accounting income included in the financial statement for those entities will be removed from AFSI, and the dividend income from those entities will be included. And again, another issue that we're going to have to worry about now are foreign entities. Like I said, they're all consolidated for US GAAP, but basically for AFSI, what's going to be included is the company's pro rata share of the income from their controlled foreign corporations. So we're going to include the pro rata share from the controlled foreign corporations unless the net amount of that is negative. It can't be below 0 to be included in AFSI. And if it is negative, we'll be able to carry that forward in the system. The other thing that's different, so again, just remember what's going on here is we have taxable income, financial accounting income, and then we're trying to compute AFSI. We're going to start with book income and make these adjustments, a few adjustments to get a little bit closer to tax for some items. Another item that's kind of similar to one of these adjustments is NOL carry forwards. And so for financial accounting, we don't have this concept of net operating loss carry forwards. If income is negative, we just report a negative number on the income statement. But for tax purposes, of course, we have net operating losses, taxable income is bounded at 0, and net operating losses are carried forward. And that tax concept, it will apply in AFSI, the adjusted financial statement income. So if there's an adjusted financial statement income loss, we will be able to carry forward that loss into future years, as long as the loss arises in tax years after December 31st, 2019. You can carry those forward. Okay, and those loss carry forwards will be subject to this 80% rule, just like they are for taxable income, 80% of AFSI, they'll be capped. Some other things just to note, and then I'll wrap up on the summary, but credits are allowed. So there's a modified foreign tax credit, general business credits are allowed against CAMTs, such as research credit, those will be allowed. The other big thing to realize with the CAMT is basically that if a company pays CAMT, they get a credit carry forward for that CAMT that they paid, this alternative minimum tax that they paid. And so in theory, it's kind of a temporary tax, but some companies will probably be subject to it annually, but if you pay it, you get a credit that you can carry forward into the future to offset years when your regular tax is greater than your alternative minimum tax. So for financial accounting, one thing that's important there is that that payment of the CAMT will actually not affect your accounting earnings. What will happen is that your current tax expense for the company will be higher because they paid more in tax currently, but their deferred tax expense will be lower because that credit carry forward will be accounted for US GAAP as a deferred tax asset. So it actually does not affect their total tax expense and will not reduce their total accounting earnings, even though it is a cash outflow in the year that they might have to pay it. So that's a very high level summary of the rules. There's still a lot to deal with. And I should say, Treasury's been tasked with a Herculean task to try to write all these detailed rules. And they are working very hard at this, but there's still a lot that we need clarification on and some more detailed rules on before we know all the rules of the CAMT.
Yeah, thank you so much for that summary. So this was passed back in August. I'm sure companies are looking at all these different rules you've explained, even at a very high level, and they get more complicated. But even before they actually do anything, do we have any evidence or have any suspicion how they might react? Or do we have any kind of former experience with taxing book income? And based on that experience, what might companies actually do?
Yeah, so back in 1986, we had a similar type rule. It was called the Business on Tax Reported Profits Tax, or the BRP tax. That was a great name. And that basically added 50% of the difference between pre-tax book income and the AMT tax base to the AMT tax base. Okay, so it also included part of financial accounting income in the tax base. And there were 5 published papers on the topic. And basically what all those papers found was some evidence that companies managed earnings downward to try to avoid the tax. Now, there is a paper that kind of questions the results to some degree. So I should caveat all that. But I think there is reason to believe that companies might manage their earnings downward in this case, and there's some reasons to believe that companies may not manage their earnings downward. So on the one hand, there's a lot more capital market pressure today than there was in the 1980s. And this CAMT only applies to very big companies that are under a lot of capital market pressure. So in that, and we do have a lot of evidence in the literature also that shows that firms will actually pay cash taxes to avoid having to report lower accounting earnings. So, and though, because of all those reasons, I think we might not expect to see companies manage their earnings downward. On the other hand, now what we have that we did not have so much back in the 1980s, it's what's called non-GAAP earnings, or pro forma earnings, we used to call them. And so you might imagine that companies would be able to reduce their GAAP earnings, say with some kind of impairment charge or something like that, and then reverse that charge in non-GAAP earnings. And they can say, well, we have to pay this CAMT, and so we're trying to reduce earnings for that, but here's the truth over here in the non-GAAP earnings. And so you could imagine some scenarios play out in that way. I think the other thing that might happen is that companies could just, take actions on their regular tax system to avoid paying the CAMT. And so I think it's an empirical question how we're going to see companies respond. And I'm sure there'll be a lot of research on these things that we can examine going forward. But I think those are some of the kind of suspicions or kind of the expectations that we'd have based on prior research.
So, I mean, what's the downside if a company pays lower earnings? Why would we worry or be concerned with that?
Oh, if they report lower earnings for GAAP?
Yep. Or just change their GAAP number.
Right. One concern is that would result in lower private information from the managers to the external stakeholders, because that's what we want financial accounting to do, is get a good measure of economic performance out to external stakeholders. And, ideally that would involve some of managers' private information about how the company's actually doing. And what would happen is if they start reporting that number in a different way than they otherwise would, if they start reporting, choosing accounting methods, changing their accruals to get to a number that's lower because of this CAMT, that will reduce the amount of private information in that earnings number and will be a harm to the capital markets. And we do have evidence of that in the prior 1986 Act due to the BURP and also due to this set of firms that were required to change their method from the cash method to the accrual method at that time, increased conformity between book and tax. So we have evidence of that in the prior literature too, that it harmed capital markets because it lowered the information in the GAAP earnings.
So that's useful, kind of useful. We kind of saw a little bit what happened 30 years ago, might give us a clue what's going to happen today. Danielle and Pat, are we seeing anything so far? So we're now in May. This has been law, I guess, for a few months. Companies are thinking about it. Have you seen any kind of responses or companies actually taking any action so far in response to the CAMT?
I'll be interested in Pat's experience. I will say I feel like the corporate reaction has been a little underwhelming to CAMT. I think there are a lot of companies that we might have thought were going to be in scope that, based on their preliminary modeling, they don't think they are going to be payers. They're in scope. They have over $1 billion financial statement income, but they don't think they are going to pay CAMT. And even for those that do think they're going to pay CAMT, a lot of them think that because it is, as Michelle pointed out, it's really a prepaid tax. If you think you'll be able to use the CAMT credit in a future year, maybe not as much of alarm as I might have thought. Now, on the other side of that, I'll say I don't know how companies can be so comfortable that they're okay. And I'm concerned that I've seen a lot of spreadsheets that are really simple. And you start asking some questions and it's like, well, they've got all these, stock-based comp deductions that are held. They don't actually allocate them down to constituent entities in their financial statements. And as Michelle pointed out, there's a separate foreign tax credit that is limited by CFC earnings, by your foreign sub earnings. And if you're not pushing expenses down to the CFCs, do you really know what that limit is? And that is just one example where I think, even based on the guidance that we already have, the spreadsheets are too simple. The second, maybe more important, bigger observation is I don't know how a company could conclude right now that they don't think they're going to pay CAMT. There are like 16 grants of regulatory authority on the statute that go to really fundamental things. And Michelle has observed, like, you can't eyeball this from the financial statements. It's a third set of earnings. Like, one of the early notices we got requires companies to apply basically our very complicated rules about tax-free transactions to layer those rules on your GAAP financial statement. So you've acquired a company, you've applied purchase accounting, you've stepped book basis up, you think you're computing earnings, on the basis of that stepped up or stepped down purchase accounting book basis. We're supposed to roll all that back in CAMT. The little bit of guidance we've gotten tells us to roll all that back, and to roll it all back, in theory, back to the beginning of time. Like, look at all the transactions you've ever done and pull out the purchase accounting. Well, has anybody really done that to really know? And there's like a million examples of that. But I don't know, Pat, do you see more alarm in your client base than I have maybe picked up?
Well, I don't disagree with what Danielle said, although I would say I'm seeing a real mix. So I would wholeheartedly agree with Danielle that companies, they're trying to model, but the modeling is very simple. Now, or simplistic. Now, at some level, that's very forgivable and understandable because, as Danielle alluded to, there is a lot that we have not yet learned in terms of how this tax is to be interpreted. There are a lot of grants of authority to Treasury. Treasury has only, frankly, really scratched the surface of the issues that they know they need to address. I mean, they're on top of these issues in the sense that they've been very clear that they have to answer a lot of questions. They don't know how to answer them. And so that's obviously an issue both for the Treasury Department, but also for taxpayers, sort of how do I know how to apply these rules? So I think some of the modeling is very simple, but I think some of that is understandable. I do think that for a number of companies, there's an element of buyer's remorse is probably not the right way to describe this, but it's worth, if you go back in time, remind folks in some conversations I have with companies, I have this very conversation that the act that brought the KMT into law was a reconciliation bill that required revenue. One of the ways to get revenue would have been, in theory, to raise the headline corporate rate. Now, there were a couple of Democratic senators who objected to that, and that got taken off the table and replaced with, in effect, what we now have as the KMT. For a lot of companies, that was great news. Now, for some companies, that was great news because they're below the $1 billion threshold. For other companies, though, even though they're like, hey, we're above the $1 billion threshold, they would have still said at the time, hey, this is good news. Why? Because to the point that Michelle made earlier, timing, it's not a rate driver. It's not going to affect my reported earnings. It's going to affect my current deferred split. So yeah, I'm going to have a cash flow impact, but I'm not going to have to worry about that. When you dive into some of the complexity and some of the unanswered questions around this, again, buyer's remorse is probably a little bit too strong of a term, because I don't think if you ask those same companies today if they would rather have a headline corporate rate increase, I don't think they would say, yes, I'd rather have a headline corporate rate increase. But I think kind of living with and having to wallow in some of the uncertainty that the KMT has brought on board, I think is something that companies are now just frankly starting to wrap their heads around. One example that I will give, and certainly welcome Danielle's thoughts on this as well, but the KMT statute provides, generally speaking, that with respect to stock incorporations, and I'm vastly overgeneralizing here, that essentially you don't use book concepts, you use taxable income concepts. And so, for example, things like dividends on stock are treated as within the KMT base. Well, go back in time before 2017, before the last very significant tax reform that we did here in the United States, there was this concept that everyone wanted to complain about, I would say rightly so, which was the lockout effect. Companies not being able to repatriate foreign earnings back to the United States because there was going to be a big pickup of residual US tax on that. The way the KMT is described in the statute, I would say it is at best just not clear what you're supposed to do with intercorporate dividends and a lot of very common fact patterns. And so for companies who are within the scope of the KMT, who, as Danielle mentioned and Michelle mentioned, are very large companies, large movements of cash on an intercorporate basis in the form of dividends potentially give rise to a huge question. Is this going to potentially put me in the KMT or as a KMT payer? Am I going to, is because this won't be, in many cases, won't be taxable. In most cases, won't be taxable for regular tax purposes. But if it's considered part of the KMT base, am I now going to drop below 15% for purposes of that computation and end up writing a big check to the government? Now, it's not all bad news, of course. Again, as Michelle mentioned, you get that money back in the future, but in some cases, you're talking about very significant, very large movements of cash. And so that cash flow impact could really be quite significant. So one of the real world impacts I am actually seeing with some companies is to some degree a reluctance to say, hey, I'm going to go ahead and pull the trigger on a big intercorporate dividend because I'm worried that this could be an issue under the KMT. And until I get clarity on that, I'm going to hold off on it. Now, that's not a great answer from a tax system design perspective, again, going back to where we were before 2017. So I think there are issues that are really crying out for guidance from the Treasury, and that is certainly one of them. So maybe I'd leave it there, but it's a little bit all over the map in response to Danielle's question to me, sort of what am I seeing? It's a little bit all over the map. Simplistic modeling, I think, yes, but again, much of that quite understandable. Some companies seemingly quite unconcerned. Other companies asking these questions, what about the treatment of some of these larger transactions that we might be looking at, and frankly, just not having the answer to them, and therefore being in a world of uncertainty around.
So you've mentioned companies that seemingly are unconcerned. They're pretty sure they're not going to pay. Are there companies that are certain they're going to pay? And if so, like what are the types of transactions or types of things that they're doing that are resulting in their certainty that they are within scope and will actually have to write a check?
Any company, Danielle, I'd love your thoughts on this. I don't know any company that's certain they're going to pay who is not now talking to the Treasury Department saying you need to fix these rules. Because what is causing them to pay in a lot of circumstances are deviations between the regular income tax and the book income tax.
So what would be an example of that?
So an example would be, for example, mark-to-market transactions where you mark-to-market for books, but you're on a realization basis for regular tax purposes. And I mean, I'm probably well over half of the conversations I have with taxpayers who are worried about the KMT. It is some version of mark-to-market. They do they're required for financial accounting purposes to mark certain assets to market on a periodic basis. For regular tax purposes, their tax accounting is on a realization basis. And the difference between those two is causing them potentially to have massive, book income that doesn't have any taxable income. Investment companies would be a simple example of this, right? Where they are required, Michelle's going to know a lot more about, both Michelle and Danielle will know a lot more about this than I do, but they are generally required to do fair value accounting. Whereas for regular tax purposes, they're quite often on realization accounting. That is just a timing difference. And that timing difference can potentially drive you very quickly into a KMT situation. And so companies who are looking at those sorts of timing differences are right now having conversations with the Treasury Department and the IRS and essentially saying, please help us to understand under what circumstances, if I mark to market for regular GAAP purposes, I have to do that for the KMT, and in what circumstances I don't. And part of the reason for that is because Congress turned off some mark to market in the statute and said replace mark to market with essentially regular income tax principles. And as Danielle mentioned, in other circumstances, Congress just gave very broad grants of authority to the Treasury Department to say, you guys go figure it out. So that's essentially a lot of the conversations that are happening right now.
And how is Treasury supposed to answer that question? Like, obviously KMT raised revenue from book to tax differences. So is mark to market the kind of book to tax difference that we should think of as a preference? Or is this a place for Treasury to exercise that regulatory authority? There's really no legislative history at all to give them a steer on that kind of question. To call out some others, percentage depletion. That's a driver, that's a potential permanent difference that is a big driver. And I think we also see like kind of a confluence, a perfect storm for companies that are cyclical and also maybe benefit from percentage depletion. So for example, the fact that, and this is so arbitrary, I don't even know how to say this in a policy discussion, the fact that the statute cuts off and doesn't give you the benefit of a financial statement loss from before 2020. So if a company lost money in say 2019, and some of the cyclical like oil and gas companies, I know this is an issue, lost money in 2019, they have NOLs from a tax perspective, NOLs carrying forward that are preventing them from paying tax. Since when is a net operating loss a preference item? If those companies also, this is not even a book tax difference. These same companies might have had a financial statement net operating loss, but for some reason the statute has cut NOLs off and says you only get the benefit of losses that are post 2019. That's just completely arbitrary. That's one hit to cyclical businesses. I think on a go forward basis, the statute just takes on a whole different view of how foreign tax credits work that doesn't align with the regular tax system's view of foreign tax credits, which I think will also come back to bite companies in cyclical industries. Because if you have foreign tax credit carry forwards from regular tax standpoint, because you had a domestic loss, for example, you ran at what we call an overall domestic loss on the US business, but it could also be operating in branch form under the US, that tax attribute under the tax rules allows you to use foreign tax credits in the future against domestic income as you recapture it. there just won't be an analog to those foreign tax credit carry forwards in this system. So it's kind of a complicated nuance point, but I think the big picture is that I think it kind of hammers companies that are in cyclical businesses. And that's odd to say that that's a preference in our tax system. It's not a preference, it's a difference. So our foreign tax credit rules that address things like overall domestic loss, is that the sort of thing that should end up driving CAMT liability? Or is that the sort of difference that Treasury should try to bridge the gap on and write rules to maybe make some accommodation in CAMT for that fact? No guidance again, but it's hard to describe running a domestic loss, in a context where we also see the domestic loss in the financial statements. So this isn't a domestic loss driven by preference items. It's hard to see why that should be viewed as the kind of preference that should be driving liability here.
I am fascinated just how much uncertainty there is, just how much the Treasury has yet to clarify and how much kind of authority Congress ceded to Treasury when they're writing this law. Now, it is the case Treasury has issued some guidance. Have we learned anything from what they've already issued about what to expect? Like the kinds of positions they'll be taking, how they think about what should be a preference versus what is not a preference, et cetera?
I would say not afraid of complexity, so we have this rule, it sounds relatively simple, right? You can sub in your tax depreciation. A last minute decision was made to protect the preference that is bonus. And so it sounds relatively simple to say sub in your tax depreciation for your book depreciation. But it's not just about the depreciation. Book also capitalizes amounts that tax will treat as a repair and doesn't capitalize. The guidance says, well, in that case, if tax isn't treating it as part of your depreciable base, then it's not depreciation. You don't get to sub in the tax number for there where book is capitalizing an amount. You're not going to keep that depreciation. You're not going to double count and also get the repair expense for tax. At the same time, tax capitalizes amounts the book doesn't capitalize. The 263 Cap A, the whole unicap regime, is a lot of capitalization of costs into fixed assets, into inventory that aren't captured for book. And we're again told that we can't double count. We're going to have to strip out and unify these numbers. That is just an example. Pat, I suspect you'll talk about the reorg complexity that we have the same setup now for big transactions.
Yeah, so I agree with everything that Danielle said. I mean, this, and in fairness to the Treasury Department, there's no escaping complexity with this. It is a complex set of problems to address, and whatever they do, they are going to make the system more complicated because Congress has essentially opened Pandora's box in doing this. So, I mean, I think the two things that I would highlight, and they're sort of really instructive as to how Treasury may be trying to think about this. So Danielle mentioned reorganizations. So, of course, from a tax perspective, if you engage in certain transactions that we call corporate reorganizations, in general, the taxpayer's gain or loss on that transaction is deferred. You say, no, it's not going to be a current gain or loss recognition transaction. And that essentially, you carry forward your basis and you would defer your gain or loss to a subsequent transaction when you have a realization event. But Treasury, early on, some issues were brought to Treasury's attention. One of them, and I can't go through everything in the notice, obviously time doesn't permit, but one of the ones that was brought to Treasury's attention quite early was the distinction between spin-offs and split-offs, right? So a spin-off of a corporate subsidiary is a pro rata distribution of subsidiary stock up to the shareholders, right? Pro rata. And because that is done on a pro rata basis, it is treated as a distribution. As I understand it, for book purposes, it's treated as a distribution, and therefore it doesn't give rise to gain at the level, the stock that is distributed is not, you don't have a gain or loss transaction on that distribution of the stock. Whereas if you do a split off transaction, which of course is not a pro rata distribution to shareholders, but rather a non-pro rata exchange by the corporation. So some corporate shareholders tender or surrender their stock in exchange for stock of the distributed corporation. That is a transaction that for book purposes does give rise to gain or loss for book purposes. both of those transactions, assuming you structure them properly, are eligible for tax-free treatment from a tax perspective. So the issue that was brought to the Treasury Department was this statute threatens to create huge distortions in the marketplace between whether a company does a spin-off transaction or a split-off transaction. We don't, we, the taxpayers coming in and raising this to you, Treasury, do not believe that that is what the Congress intended. We do not believe that they intended, by enacting the CAMT, to provide for vastly different treatment of spin-off transactions from split-off transactions, because they get the same treatment for regular tax purposes. And obviously, it's sort of it's an obvious point to state, but the numbers we're talking about here, when you're talking about a large corporate separation by means of a spin-off or a split-off, are well in excess of what for many companies would throw them massively into the CAMT, right? Massively into it if this was treated as a taxable transaction for purposes of the CAMT. So Treasury ultimately in that guidance said, hey, we're gonna turn off that. We're gonna basically tell you to follow tax for the spin-off, split-off thing, right? So that you can see, and again, going back to Danielle's point, there's an effort there to say, hey, we want to align book with tax, but we can't align with book with tax on everything. If we have a 21% tax on taxable income and a 15% tax on taxable income, one of those is not going to raise any money. So since we know that Congress intended to raise money with this 15% tax, we know that there have to be some differences in the base. But Treasury is fundamentally comfortable on that to say, that's not a difference in the base, that spin-off, split-off difference. That's not a difference in the base that Congress intended. Now, I'm going to contrast that with something that Congress did do in the statute. I mentioned with respect to stock interests. So in the statute, Congress essentially provided that, hey, with respect to stock interest, and again, I'm generalizing, with respect to stock interests, we're not going to apply mark-to-market concept. We're going to apply tax realization concept. So dividends and sales of the stock will get picked up in the CAMT base. But we're not going to apply mark-to-market concepts. Now, you look at that and you say, well, maybe that's a helpful and a good answer to taxpayers because you're aligning the regular income tax on that issue with the book minimum or the CAMT base, and that essentially may help to eliminate some distortions. And I think for a lot of taxpayers, that was true. It wasn't true for insurance companies, because a lot of insurance companies looked at this and they said, hey, maybe in theory that makes sense generally, but we have a real problem as a result of what Congress did in this statute. We have investments that, frankly, from an economic perspective, align with liabilities that we have to policyholders. Congress, in enacting the CAMT statute, turned off mark-to-market for those corporate investments, those corporate stock investments. But mark-to-market for the other side of that integrated transaction that we see, essentially the investments and the liabilities, mark-to-market was not turned off for that. So now we have this massive mismatch. We turned off mark-to-market for one half of an integrated transaction. We didn't turn it off for the other half, or integrated investment. We didn't turn it off for the other half. And so now, as a result, the Congress has introduced a distortion that is large enough that it is threatening the solvency of some of these, of some insurance companies. Literally that big of a number, threatening the solvency of these companies. They went into the Treasury Department and said, we are going to have a liquidity problem if we have to mark the one half of this integrated transaction to market and pay tax on that. We are going to have a liquidity problem. So that message was received by Treasury, and then they came out with guidance specific to the insurance industry on that issue. So that's another example of something where they essentially looked at this question of conforming book and tax. On the one hand, they looked at spin-offs and split-offs and said, yeah, we got to figure out how to do with that. On the other hand, they took something that Congress had done that created a knock-on effect that they said Congress definitely did not intend that. But essentially, by solving a problem for a lot of taxpayers, Congress created a problem for another class of taxpayers. And now, like they felt like they had to solve that. So again, I think what it tells me, Jeff, is Treasury really does have their work cut out for them, because in so many of these areas, as they look at these transactions, they're confronted with a couple of questions. One of which is the point Danielle made, which I think is a really important one. If we fix every difference between book and tax, we will eliminate the base of this tax fundamentally, and we can't do that. So without any legislative history, what kind of guidance can we have? Point one. Point two is, if I through regulations or other form of guidance fix something, what knock-on consequences am I creating that I haven't thought about in some other area or to some other class of taxpayers that may actually be making matters much worse. And I think they're really struggling with that second issue in terms of as they think about these mark-to-market issues. If I try to address this, am I creating another set of problems that maybe is not a problem today, and that's why nobody's complaining to me about it? But if I solve something for one group of taxpayers, am I opening a new set of problems for another class of taxpayers that are now going to have to come in, and I got to solve that problem. So it's a real challenge.
So I
An
mean, this,
easy example of that is we talked about the notice said we'll give tax-free reorg treatment for transactions. And the notice read literally, which is reliance guidance. Taxpayers are told they could rely on this notice. But it presents a question of, I said, if you read literally, you're going all the way back to the beginning of time and reconstructing your balance sheet by disregarding purchase accounting at the beginning of time. I think there are a lot of taxpayers out there, the government has heard from them, that are very hopeful that the government will cut that requirement to go back in time off. But what about the taxpayer that acquired a business with assets that have depreciated in value? They're counting on that basis of those built-in loss assets, because tax-free reorg treatment that the government promised in the notice would give them that basis. But if we cut that off and we say, no, we want to hold on to your purchase accounting for transactions like before the CAMT guidance came out because it's too complicated, now those taxpayers sitting on built-in loss assets are upset and surprised.
I think I'm extremely convinced this is complicated and that we're kind of wondering, about how the tax is actually supposed to be calculated. We're still waiting on the treasurer for a bunch of different things. Is that just because business is complicated and corporations are very complicated, or is this like more complicated than other taxes? So for example, back in 2017, we had GILTI and FDII, these kinds of things. Was it the same kind of feeling that we just had to wait for treasury? It was complicated, or is this different? And if so, why is it different?
I think it's different because Treasury doesn't understand GAAP. I mean, they've learned a lot about it from the whole OECD Pillar 2 exercise. I think we've all learned more GAAP in the last couple of years than we had before. But I think this is different because they're like GILTI was built on our notion of taxable income, our rules about what is taxable income. I mean, some of us, I've heard Michael Gretz observe, it's like they built a Mack truck on top of a car chassis. When they did that, they took issues with those rules and made them much bigger, but they were rules we knew. The subpart F system we knew. Here, this is like working up from GAAP, which, I've learned more GAAP in the last 2 years than I knew before, but it's like you can fill a thimble with what I understand. And I know the same is true at Treasury. They don't have GAAP experts at Treasury. So they're like, and so there's that problem of they don't even know what the base is. And then they're trying to rebuild the code. Tax-free reorgs exist for a reason. I got to rebuild the code now. There are all these situations where they're basically rebuilding the code from the bottom up from a base they don't actually understand, unlike the GILTI base. I think it's way more complicated.
I agree with it. And I'm gonna get Michelle back into this part of the discussion, because I think, one of the things that I have learned, and I'm not even an accountant, but certainly I'm not somebody who had a deep understanding of GAAP. Everything I learned from working in-house inside of a company for many years. But I will say, one of the things that Treasuries has been struggling with, and I know this because I've had some meetings with them to talk about these issues, is they will ask the question. And again, as Danielle said, and this is not their fault, they are not GAAP accounting experts, they are tax law experts. They will very often ask questions that sound something like, what is the GAAP rule for this? What's the rule in the accounting literature for this? And again, something that I have learned is very often in GAAP, there's not a rule, there's a principle, and taxpayers, or I should say, filers, companies that prepare or that file financial statements are asked to exercise their judgment. And so there's a much more than in the tax law area, where we as tax lawyers would say there's a rule that tells you what you do, and the rule is the rule. Now, you may have elections and things like that, but much more so than I have found in my limited exposure to this, much more so than in GAAP, you would say, yeah, I just got to figure out where the rule is. It's in the code, it's in the regs, it's somewhere. In a lot of cases for financial, for GAAP, there is much more of a judgment-based approach, I am finding. And I think for people in Treasury, I know from conversations I've had, that is something they are finding a little bit frustrating. So a very granular example, like what's the rule for the tax accounting treatment, or excuse me, for the GAAP accounting treatment of embedded derivatives? Well, there's not a rule. There's a whole bunch of principles and concepts that you know, people who prepare and file financial statements have to kind of come to grips with and do as part of their presentation of their GAAP financials. But there's not a rule in the way that Danielle and I would understand the tax accounting for derivatives. Okay, yeah, I can tell you where to look for that rule. I may not know all the details, but I can tell you where to look for that rule.
Yeah, I would agree with you, Pat. I think you've learned it exactly right. I think there's a lot of discretion in financial accounting and a lot of room for judgment on the part of managers. The other thing I think that's true in financial accounting is sometimes there's a choice. You can account for something this way, or you can account for something this way. And I think maybe this discretion and the choices that managers have, maybe that wasn't all appreciated by Congress when they put this rule into place.
I think it very much goes back to the concern you raised, Michelle, that companies could use that discretion to then end up reporting different numbers that will lose some kind of information to the markets, which I do think, I mean, I think this might happen longer term, but have we seen any evidence of companies changing their financial accounting so far, or is that just yet to be seen? Does anybody have any experience with any financial accounting choices actually being changed as a result of this so far?
I don't have the experience of seeing it. And I would ask Michelle, like, I think there's two different kinds of choices we might be worried about. One is where there's different ways to do it. Like there are like actually places where there's like 3 choices. I'm thinking about transferable credits, how we account for all the transferable IRA credits, 3 different ways to do it.
Yeah.
My understanding is that you can't just willy-nilly change your accounting policies. Once you have adopted a policy, comfort us, Michelle. I can't just willy-nilly change my accounting policy, right? As opposed to maybe how I apply that policy to factual situations. Maybe you could help us with that difference.
Yeah, I'm not sure your definition of willy-nilly, Danielle, but you know, these things can be changed. But of course, these companies will have to deal with their auditor also, and so it's supposed to be a correct reflection of what's going on at the company, you know, their performance and the best reflection of income that they can have. And that's what they're supposed to use under GAAP. You know, it's some choice on the part of managers, but they're supposed to use that in the right way. Now, of course, they can use that opportunistically sometimes. And we do have evidence in the literature of companies doing that. So I think there is a risk, but of course, and I think it will, and I've said this before, but I think it will put some pressure on the relationship between the client and the auditor, perhaps, because you know, the client might want to do something and the auditor might push back. And so you might see some more disagreements between the auditors and the clients on these issues, or at least some more friction. But they shouldn't just change willy-nilly. I mean, I agree with you, Danielle, but if they can, you know, say that these facts have changed and now this is a better reflection of income, maybe they can do that.
So we obviously, you know, enacted this tax because people were upset that we had very large companies who were paying very little in tax. Is there something differently we could have done, Michelle? I'd like to hear your opinion on this. So is there some kind of different thing we could have done to correct that perceived problem by the people for whom that bothered?
Yeah, I think there's a lot of things we could have done that would have made more sense. And, you know, it kind of goes back to what is the problem that we're trying to solve here? Do we actually think companies aren't paying enough tax? You know, has Congress been too generous in giving these benefits to them through the tax code, or do we think they're evading tax somehow or something like that? Is that the problem? Or is it really just that Congress doesn't like companies showing a lot of accounting profits and the press saying that they haven't paid any tax? You know, but if we just want companies to pay more tax, or for some reason we don't like the deductions that are in the tax code now, we could have just changed the tax code. You know, if we think stock option deduction is too generous, just change that. If we think depreciation is too generous, just change that. You know, all kinds of things that we could have changed just in the tax code, and you wouldn't affect financial accounting and you wouldn't affect the capital market, you know, any risk to harming the capital markets and all this complexity now that Treasury has to deal with. You know, the other things you could do is just kind of think about like what we've done with NOLs and with interest deductions, where we cap them somehow. You know, we have the interest deduction limitation now based on 30% of EBIT now. But you could cap them, you know, and say it can't be greater than X% of taxable income without this deduction or something like that. And you could even do that as a bundle, say all these, if we're worried about 5 deductions, we just don't want companies to take these 5 deductions to too large of a degree for some reason, if that's their concern, you could bundle those up and say those can't be greater than X% of taxable income or something like that. And again, then you wouldn't have to bring in all this machinery from financial accounting and make everybody learn GAAP, and you would still kind of constrain the amount of deductions that companies take. So I think, there's this would basically be like you could even just put in an old style AMT and just decide what your preferences are, So I think there's lots of ways that this could have been done without all this complexity of bringing financial accounting income in. I think it's very tempting for people to do that. It sounds simple, like there's this income sitting over here, let's just tax that other income. But then when you dig down into the details, like Danielle and Pat were going through, it's just very complicated. And you realize, oh, we don't really want to tax these things that are in financial accounting income, like mark-to-market accounting.
That is the thing that strikes me is this was, initially it was kind of sold like as a simple thing. It's like, we already have this number. Let's just tax it. It's like going to solve all of our problems.
Yeah, no.
But so far it doesn't appear to be that's how it might work. So if there are these alternatives, I'm interested in all three of your opinions on this, if you're willing to offer them. What are the chances, do you think, that we'll have the CAMT, say, by 2025? Are we going to come up with some other way to raise revenue? Or are we just going to forego the revenue? Are we going to keep it because it's politically intractable to get rid of it? What do we think about the future of the CAMT?
Well, I'll go first, only because nobody else was leaping in. I don't, obviously none of us know. I suspect this is going to be around. I know some people would love to see it go away. We are in, to state the obvious, a severely revenue constrained environment, and we're, the delta or the gap between the money that Congress is spending and the money that Congress is appropriating is obviously quite significant and shows no sign of disappearing. And as a result of that, the idea of saying, this seems like it was a bad idea, let's just get rid of it, will have to be accompanied by, and we're going to replace it with something else. And I think, going back to Michelle's point, I think the reason we got what we got is not because it is technically easy, but because it was politically easier than the other alternatives. Like, well, it scratched an itch, exactly to Michelle's point. We don't like large wealthy corporations having a lot of book income and not paying any tax. So it scratched an itch from a political perspective. That itch is not going to go away. It may not go away with this tax, but it won't go away if you repeal this tax unless you can replace it with something that kind of gets at that same concept. And anything else that you would do, I think, would require Congress to, effectively roll up their sleeves and spend more time thinking about the hard choices that, Michelle alluded to. What are the kinds of things that we as Congress think, well, maybe we shouldn't be doing quite so much of that. Maybe we should be limiting this. And behind every one of those decisions is some group of taxpayers coming in and explaining why that's a really bad idea to a member of Congress. Like, you understand, if you do this limitation on NOLs, or you do this other limitation, it's going to cause a real hardship for me. And I don't think that's what you intend. So change is hard. This scratched a political itch. The revenue needs of the country are such that I think the idea of just saying, never mind, is simply not on the table. So I don't really see it happening. I don't even think I really see it happening if the Republicans have unified control of government, candidly. And indeed, the chairman of the Ways and Means Committee, who is, not, I would say, he's free to offer his own opinion on things. He very frequently offers, his opinion on things, has himself made clear that he would not regard it as a priority to get rid of the CAMT. If they had unified control of government, he himself, now that doesn't mean his caucus would feel the same way, but he himself would not say, yeah, we're going to get rid of this thing. So none of us knows the future, but I wouldn't be betting on this thing getting torn out by the roots anytime soon.
Sadly, it's politically easier to pass a tax that nobody understands than it is to actually, like Michelle's idea of, let's identify the discrete deductions we're worried about. Well, now you've just mobilized a lobby. Passing a tax that nobody understands and passing it fast is politically expeditious, in addition to the point that Pat made about scratching an itch. There's some nice talking points around the idea of these companies not paying tax that are reporting profits. Of course, the rules are totally different and designed for a completely different purpose. Maybe this is a place where it is worth pausing to acknowledge that there is this other book minimum tax in the world, the Pillar 2 book minimum tax. But there they chose a GAAP or an IFRS base, depending on who you are, for different reasons, not because they distrusted the tax rules and distrusted the tax base. They just needed a common language. So they had to pick a common language, and then they readily like substituted in tax concepts where they could agree that substituting that tax concept in, including just under local rules, even if it's different, wouldn't disrupt the common language. They needed a common language because of maybe a distrust of relying on local bases. This one's like totally different. It's a distrust of our ability to construct a tax base. Congress's distrust maybe even of itself to construct a tax base. It's just like a complete different motivation. And as a result, it is totally different drivers of tax liability under this other book tax that's out there.
Yeah, I don't disagree with anything that Pat or Danielle just said. The only thing I would add is I kind of wonder how much revenue this will actually raise, or how much revenue it will look like it raised. In other words, if companies do things to avoid paying it, it's not going to look like it raised any revenue, even though maybe, you know, it kind of did if they take action to report a higher regular tax income, for example. So if it doesn't show that it's raising any revenue, then maybe they'll have to re-examine it and think about something else, or maybe they'll just get more aggressive and go after, you know, make different adjustments within the KMT. I mean, I don't know, but like Pat said, we can't predict the future, but I do wonder how much revenue this is actually going to raise.
That's a perfect segue to some audience questions. So somebody asked specifically about this revenue, and we obviously passed this tax to raise revenue. It induced all this complexity. We've talked about it. Do you think, any of you actually, do any of you think that it's worth, the revenue that we'll raise is worth the complexity?
I mean, I don't, as an accountant, I don't think you get any accountant to say that it's worth the revenue that they think they're going to raise. I mean, it's just such a risk to the integrity of the financial accounting system and the financial accounting standard setters. I don't think any accountant will say that this tax is a good idea. I think we could have done it some other way that would keep the accounting clean.
Okay. Need to add that, Pat or Danielle?
No, I would offer the same. Now, I will, Danielle mentioned Pillar 2, so I can't help but offer that I feel the same way about Pillar 2. It's not worth the complexity, and it could have been made a lot simpler. But I think that this idea of starting with book concepts does bring with it, and I would describe it as almost an irreducible level of complexity, because there's no way to marry these two things together without an enormous amount of complexity. And so I think there were, king for a day, there are easier ways to raise the requisite amount of revenue raised by this tax, no question.
But in a world where we have Pillar 2, to add a third different book tax that doesn't help US companies and actually has the risk of hurting them in the Pillar 2 computations is really bizarre. Really bizarre. I do not think it's worth the complexity.
The world does seem to have an addiction to minimum taxes, and we were a leader in that. We, the United States, were a leader in this addiction, in propagating this. So I suppose we have something to answer for in that regard. But of course, we had the GILTI, we had the BEAT. These are all versions of minimum tax, right? We now have the KMT. I mean, we could go on and on. So it's quite remarkable.
I have a few questions from participants asking about the implications for state taxes. So my understanding is some states conform to federal taxes, some don't. Do any of you have any insights into the state implications for this tax?
I know somebody that does, and I asked them. Most states conform to the taxable income definition. So actually they don't and haven't historically conformed to the corporate AMT. However, I think Alaska does and did. So I think this is a live tax in Alaska. Big state, maybe not a big economic impact that the KMT is a live tax, although maybe I shouldn't say that because I've already noted depletion and other exposures for oil and gas companies. But Florida, I guess there is a question because the next time Florida conforms, they have historically conformed to the KMT. And they conform to the, sorry, I meant to say the old corporate AMT. We didn't call it KMT when it was the old corporate AMT. They had conformed, and there is a question of whether that means that they will conform to this version. But the general answer is no. Those are two outliers.
Okay.
But they could change their mind if they'd come around to needing revenue instead of sending us all extra checks.
So one question mentioned that they have heard that one of the biggest differences that the CAMT picks up is the exemption of foreign earnings from US taxation. Why couldn't we, and this person asked, why couldn't we just raise the GILTI tax rate instead of have this book minimum tax?
Look, there are no easy revenue raisers. We should be clear on that, right? There are no easy ways to raise an awful lot of money. And I think, raising the GILTI rate, Danielle said you'd have an army of people in saying, why that's a really, really bad idea. On a blank sheet of paper, any number of things are possible. Again, I mentioned at the start of this conversation, you could have raised the same amount. I can't remember exactly how much revenue was raised by this, but you could have raised the same amount of revenue raised by this tax with probably a 1.5 to 2 percentage points increase in the headline corporate rate. Look, it doesn't get any easier than that as a design matter. It's one line in the code. Cross out 21, replace it with 22.5 or 23. But it turns out that's really hard. And that's why a big part of the reason why we ended up with this. So, I find that question really hard to answer because you say, well, yeah, you could raise the GILTI rate. You could do a lot of other things. Theoretically, this ended up being, by definition, the easiest thing for Congress to do because that's what they did.
And this is a tax on a different base because income that's subject to GILTI, that gives you current tax expense. But in particular, like where there's income that's not subject to GILTI, like the taxpayer that has a lot of assets abroad and they're enjoying the 10% return on qualified business asset investment. This is a tax on that in particular, or a tax on income that was offset by losses in CFCs. Like this tax is shaped differently than just raising the rate on GILTI, for better or worse.
So we've talked a lot about revenue. We are now in May of this year, so we're 5 months in, which means some company might have actually had to send in a quarterly estimated payment or some kind of estimated payment. What are they actually doing to determine the amounts of those estimated payments? You mentioned it's difficult for them to know whether they're subject to it or not, how much. So what do you do?
What do you do? I am not an estimated tax expert, but I think I've learned that companies that had positive taxable income in the prior year had safe harbor planning available for them for purposes of their estimated taxes for at least the first quarter. But now I think it's June 15th is the, this gets real. And the lack of guidance puts those companies in a really uncomfortable position. Pat alluded to the fact that with right now, if you pay dividends up from your controlled foreign corporations, your wholly owned foreign subs, if you pay dividends up in certain circumstances, those dividends are getting included in the base, but aren't being included, in regular tax. The same income may be being also included in the CAMT base because you're required to directly include your foreign subs financial statement income in your CAMT base. There is a double counting there. And I think we all believe Treasury is going to do something to reduce that double counting, but there's a huge question about how far they're going to go. Is it double counting if the CFC's earnings were earned before CAMT effective date, so they weren't actually subject to CAMT? Companies are having to make bets, I think, now with estimated taxes due if they have been paying CFC to CFC dividends up from CFCs out of pre-CAMT MP. They either have to let go of the cash for the time being or make a bet that Treasury is going to give guidance that's favorable on some of these. Seems like they obviously will questions, but we don't have it in hand yet. And that's just like one example of, do you bet on the law as it currently stands, or do you bet on what you think Treasury is going to do and face the penalties if you're wrong? We've been asking Treasury to take that into account and give us guidance.
I agree with what Danielle said. I mean, I think that, look, this is not the first time for companies, a lot of questions, obviously, after the TCJA was enacted and we were awaiting guidance on that and sort of what do we think is a reasonable position to take. I think for the companies who are in the scope of this tax and having to address these questions, from my conversations, they're doing exactly what Danielle said. Essentially, we think this is the way Treasury may come down on this. We hope this is the way they may come down on this. Therefore, we're going to make our estimated tax payments on that basis. And if we do, we recognize we may be wrong. And then we've underpaid estimated taxes.
Which reminds me of the companies that all bet that R&E capitalization would be repealed by the end of the year, or split the baby for their estimated tax payments because the number was just too big, and then they
Right.
find themselves under because Congress didn't do what they were supposed to do.
Right.
So we have another question on whether this will affect companies' kind of responsiveness to new tax incentives. So especially with long-run decisions, if there's all this complexity, we don't know what the law is going forward, Congress could pass more laws that are complex. Is this going to have any effect on how Congress has the ability to actually change corporate behavior with tax law, with incentives?
Guess
Well,
it- Go ahead, Pat.
I was going to say, I mean, look, I think we have to define what we mean when we say incentives, right? So when we think about general business credits, as Michelle alluded to, the KMT generally provides a combination for general business credits. And I think that was obviously a very clear advertent decision that Congress and indeed the administration made, going all the way back to the Biden administration proposal on this. So that, by the way, I would contrast with Pillar 2, the other minimum tax that we're not really talking about. But in Pillar 2, that I think raises real questions about whether or not there's a continuing efficacy of incentives that could, really could be undermined potentially by the application of Pillar 2. But I think with the KMT, at least if you're talking about credits, it's an easier question. Now, I suppose you'd also have to think about other forms of incentives, as well. FDII or something like that could come to mind as something that potentially at the margins you could see some impact on. I will say, in the real world, that is not a conversation that I've had. I've not had a conversation with a company who says, hey, I'm running the math, and it turns out this congressionally intended incentive is no longer worth as much to me because of the KMT. This also goes to a point that Michelle and Danielle both alluded to, which is, if you are subject to the KMT, and it's because of some form of an incentive, you're essentially swapping out one tax attribute for another. So you don't get the benefit in the current period, but you say, okay, well, I'm gonna book a deferred tax asset, and I'll be able to get the benefit of that. Maybe it's next year, maybe it's a couple of years later. May not be ideal, but you're not walking away from the benefit of the incentive entirely. So I think there are design elements of the KMT that both advertently from Congress's perspective, but then just more generally because of the timing nature of the way it's designed, I would expect the impact on incentives from the KMT in particular is probably going to be quite a bit less than we would see with, for example, a Pillar 2.
So I mentioned somebody had the question before about the GILTI and just increasing the GILTI tax rate, and that was kind of due to the fact that exempted foreign earnings are one of the major things that are driving this tax. What are some of the other major things that are driving this tax? Just if you had a bolded list of these are the biggest items that are causing large KMT liabilities or will cause large KMT liabilities, what would that list include?
We've called some of the big guys out. So like I highlighted percentage depletion, cyclical businesses. There are other areas of like big uncertainty. So like kind of a similar question about the CFC earnings. There's also interest in partnerships and what I'm told to take a distributive share of the partnership's adjusted financial statement income, and that are you able to even get that information from a partnership? What are we going to require? Like, remember, this only very limited number of taxpayers are subject to this tax. So are we going to add this to the reporting requirements for all partnerships? Is there going to be some process if you have one of these large taxpayers that's a member? And what's a distributive share of adjusted financial statement income for a partnership? We have tax rules that tell us about distributive share and just complicated rules for what each partner's interests in the partnership are. How do I translate that now into financial statement income? And by the way, if the partnership operates abroad, when and to what extent do I get a foreign tax credit for its income? It's just like silent, completely silent about that. And, like that's kind of a big deal. One of the preferred entity choices is often a partnership, including for very real joint ventures where you might not have a controlling interest.
Yeah, I think Danielle points out partnerships, which I couldn't agree more. That is a hugely underappreciated source of uncertainty and complexity associated with the KMT. The number of taxpayers I talk to who say, I may have interests in partnerships that go down 4, 5, 6, 7 tiers. And a really important point Danielle made, I just want to underline, because this is only the largest corporations in the world are subject to it, that partnership 7 tiers down has no idea that they're supposed to be computing some adjustments to regular tax. They're just sending a K1, which is obviously a regular tax computation, effectively on up the chain. So kind of reaching down through multiple tiers to try and get that level of information to find out what the adjusted financial statement income should be is, I would say an impossibility. So the question is, what do you do about it? Because it's not actually practically achievable to get that level of information. But Jeff, the other thing I would just highlight, just going back to the very beginning of one of Danielle's first comments, stock-based compensation is, and that's just, something that for a lot of companies is going to be just a huge book tax difference. So the two things that come to mind to me right off the bat are stock-based compensation and mark-to-market. And mark-to-market is one that Treasury we know is grappling with. Stock-based compensation, they are not.
And it's a wild card. Like you can't predict it. So you think you're not subject to the book tax, but if lucky your stock price climbs.
Right.
So that, the fair value at grant date looks different than at exercise. And all of a sudden you've got a really big tax deduction that's not matched. It's like just unpredictable. You can't control it. That's the kind of difference that Pillar 2 decided to reverse out. That was one where they understood, we'll just use the local tax rule for stock-based comp. Well, KMT, this is a major exposure item for companies. I'm glad you came back to that, Pat. I think we'd under-indexed on that one.
Yeah, I think the equity-based comp too, it seems like a weird outcome to me because the employees are including that income on their tax return when they get that pay. So they're including it at the individual statutory tax rate, 39%, possibly 39.6 pretty soon. Whereas the company's getting a deduction at 21, but they just don't like it because the book expense is different, but it doesn't make any sense to me that that's what they should be concerned about. I mean, they're getting the revenue on the individual side. But yeah, in a year where the stock price goes up, that's going to be a big difference potentially.
And why on earth is that a preference item? But it also might be a reason that some companies are feeling okay about what their what their modeling shows them today, particularly in the tech sector. Their stock is a little depressed. If we get back to good years, that's a whole different, it's like, oh, great. They'll still net on balance, I'm sure be happy, but it may change the KMT exposure quite a bit.
Right. You get to go into the CFO and say, I have great news. We're not going to have to pay the KMT this year. And it's because our stock price is in the tank. It's not necessarily going to be great news across the board, but it's at least great news when it comes to the KMT. Right.
And on that note, thank you all. Thank you, Pat, Michelle, and Danielle. This has been a really great panel. I think we kind of are convinced Treasury has its work cut out for us, and taxpayers have the work out for them trying to figure out what to do with the KMT. So we will have Eric Toder next to introduce our keynote speaker. But before Eric, we're going to have a brief poll. So take the poll, and then we will hear from Eric.
Hi, I'm Eric Toder. It's my pleasure to introduce our keynote speaker, Itai Grinberg. Itai is a professor of law at Georgetown University, where his research focuses on international tax policy. During the first 2 years of the Biden administration, he was Deputy Assistant Secretary for multilateral negotiations at the US Treasury Department, and he was the lead US negotiator for the global minimum tax endorsed by leaders of the G20 in 2021 and subsequently agreed to by many countries. I would say I can think of few more important efforts in recent years than the work on trying to reform global tax rules for multinational corporations. And I look forward to Itai telling us both about his experience in his negotiations, his assessment of the product and the state of affairs, and his thoughts on what should be done going forward. So turning it over to you, Itai.
So thank you for that kind introduction, Eric, and hi, everybody. I want to thank Brookings a ton for inviting me to give this short address. And from Eric, I understood initially that my role will be to talk about the global minimum tax, so pillar 2 of the OECD G20 international tax deal, which of course, unlike the things that were talked about earlier, is not yet a mechanism by which the US is raising revenue on corporations because we didn't adopt GILTI on a country-by-country basis. But before I do that, and I'm actually ad-libbing, given the last panel, I do feel like I need to go off script and connect the conversation to CAMT some, in part because from my formerly inside the administration vantage, I would disagree with Pat Brown's suggestion that the alternative to CAMT was to raise the headline rate, or sorry, rather, what I would say is that for much of 2021 and 2022, many of us inside the Office of Tax Policy thought the choice Congress was pondering was rather whether to adopt GILTI country by country at 15% or CAMT at a 15% rate. First, because they scored somewhat similarly, but also because honestly, at a very superficial level, they sounded similar to a non-expert, which Danielle also kind of referred to in her remarks. 2 different 15% minimum taxes. And that's a part of why the decision became framed as which of the 2 to support. And one of the consequences of that I do think the taxpayer community should appreciate is that the people who lobbied against GILTI by country by country at a 15% rate were in effect lobbying for CAMT. And as someone who does not view CAMT as good policy, I have to say that although I wasn't allowed to say it publicly in the outside administration, that tortured me for most of 2021 and the first half of 2022. Because I don't love CAMT. And of course, what we all know is that TCJA has a ton of expirations and rate increases at the end of 2025, not only on the corporate side, but also on the individual side, which means a tax bill in 2025 is basically a must-do for Congress, regardless of the composition of the Congress in terms of which party controls which House of Congress or whether control is split. And it is a difficult environment in terms of needing revenue. And, Pat made that point too. And possibly because of the lobbying against GILTI country by country in 2021 and 2022, what we may now end up with is CAMT plus GILTI country by country. And again, it would be better to have a more sensible policy than CAMT. And of course, we could adopt a better and more sensible policy and legislate a qualified domestic minimum top-up tax in place of CAMT, which is much more sensible from a tax policy perspective. And the estimates suggest a QD-MTT would clearly raise as much revenue as CAMT was scored to raise, although not that much more. And I just think Danielle and Pat's criticisms about CAMT are right, including their point that there are a ton of things Treasury could do or not do that might change how CAMT gets modeled as a bigger or smaller cost for companies. And as they pointed out, CAMT was supposed to raise revenue, like 220 billion of it, and Treasury knows that. So, I understand mark-to-market transactions for books as a policy matter, that shouldn't be causing tax, and taxing NOLs is really silly. And the CFC earning issues are there too. But given what the statute says, that doesn't mean those things won't be taxed. And while that might be less bad than GILTI country by country as a sheer cost for some companies, it seems clear CAMT will be worse for others. And given all the oddities of what CAMT taxes, the companies that CAMT will hit, it just seems like there's less reason that they should be paying more. So I think that's all unfortunate. More generally, an irreducible problem with CAMT is that it's often a tax on timing differences. That just doesn't make a lot of policy sense. And of course, that's very different from Pillar 2. Something I appreciate Danielle kind of pointing out, because Pillar 2 also uses book as a starting point, as the basis for an attempt at more global coordination, at least as to a minimum tax regime. But it systematically avoids the timing difference problem, because that's not great policy. And that's Danielle's point about readily putting in common tax concepts, but starting from a common language, so everyone could start from a single base, and understanding that otherwise you had to worry about individual states' like legislated income tax base, and you couldn't trust there not being defection in that regard, whereas there was stability to the sort of FASB, US GAAP, IFRS conformity project, and the basic structure of the rules being mostly similar, with occasional exceptions, admittedly. And that gets us to Pillar 2. And unlike Pillar 1 of the OECD G20 agreement, and unlike what has so far happened in the US with guilty country by country, abroad, it's pretty clear that we've passed a tipping point on Pillar 2. Why do I say that? Just to level set for everyone, Japan, the third largest economy in the world, has already enacted legislation on Pillar 2. And that's for purposes of, that's QDMTT and the income inclusion rule and UTPR. South Korea's done the same. The EU, which on a combined basis has an economy that's roughly the same size as ours, has enacted a directive that requires all member states of the EU to put Pillar 2 in place, or else face enforcement litigation from the European Commission, which the European Court of Justice can, make binding. And numerous other jurisdictions have ongoing legislative processes that will soon enact Pillar 2 too. So, for globally engaged M&Es, the reality is that, Pillar 2 as something they will need to grapple with is a done deal. Now, that then gets to the US perspective on Pillar 2. And I think the key point to make is that when Pillar 2 is globally implemented, it's going to make it so that both US and foreign headquartered MNCs face a substantially common level of minimum taxation. That means that the Pillar 2 agreement very substantially levels the corporate playing field. And in doing so, it really did meet the single most frequently heard international tax policy request made by the US multinational business community over my entire career in tax, at endless conferences and hearings that I either attended or read the transcripts of. But I think it's important to just reflect, why was a level playing field the stated goal for 25 years? And I just harken back to the policy rationales Mark Weinberger articulated when he was Assistant Secretary, because he gave testimony about this. And his stated principles for good international tax policy for multinational enterprise were, hey, the rules shouldn't place an undue burden on the competitive position of US-based M&Es. The rules should minimize distortion of investment decisions through tax considerations. The rules shouldn't create a bias for or against particular activities. The rules shouldn't serve as a barrier to cross-border investment. And then on top of that, there was, beginning in the late 90s and early 2000s, this growing concern about tax creating incentives for cross-border M&A that favored foreign over domestic M&Es in acquisitions of smaller companies with products destined for global markets. So those were the concerns and the criteria, and all of that really does sound like old school tax policy talk. And we all actually know that unilaterally enacting GILTI did not actually speak to or particularly ameliorate those cross-border tax policy concerns, even though simultaneously lowering the US headline rate was quite popular with business. Because as Pat Brown said years ago, GILTI by itself, without other countries doing something similar, was off-brand. It didn't change the fact that planners, and now I'm speaking for myself, had incentives to move income to low tax jurisdictions and deductions to high tax jurisdictions. And the US was not a low income tax jurisdiction, even after TCJA. And at least as long as we don't have a value added tax, the US is not going to be fiscally able to become a low income tax jurisdiction. And indeed, in 2017, many argued that setting aside the headline rate decrease, going alone on GILTI would aggravate the problems with the US system and in the long run impair US competitiveness and lead to a loss in economic opportunities for American workers. Exactly because we were acting alone. But GILTI was enacted anyway by Republicans. And that does not mean the claim by the private sector unilateral GILTI opponents was wrong. I think they had a fair point about the risks on the incentives. Under GILTI without changes in foreign law, companies still have incentives to shift income abroad to blend down to the GILTI min tax without Pillar 2. And given without Pillar 2, the way that the foreign rules are structured after BEPS 1, and given the DEMPI rules, they have some significant need to move good jobs abroad to do that successfully, right? And the Biden administration was elected with that GILTI result as settled US law. And with that as the baseline, Pillar 2, global minimum tax, when enacted by foreign sovereigns who are moving really far in the direction of, and in the country by country respect, going beyond the US, current GILTI rule, well, that really does help reduce all of those competitiveness and economic distortion concerns. People said GILTI would magnify over time in the run to GILTI being enacted. And it strongly improves the incentive to book income in the US, and therefore lessens the DEMPI-driven need to keep certain kinds of high-paying jobs abroad. And all of that just gets us much closer to Weinberger's first best. And GILTI country by country could have been instead of CAMPI, and it would have scored similarly. But that's all still in the realm of international tax policy. And an equally important thing to keep in mind is that the administration saw Pillar 2 as part of a much bigger international economic picture. So yes, agreeing the global minimum tax met the level playing field objective, was important. And we thought, hey, this could stabilize the corporate tax globally in the doing. But the Biden administration also said that while this was good international tax policy, it was importantly more than just good international tax policy. Rather, the administration consistently said that by ensuring that the global minimum tax was put in place, we were also building a foreign policy for the middle class. And we said it was, about restabilizing international economic multilateralism. And coming out of the Trump years and looking at the political climate in various other developed economies too, I think the right overarching question is, how do we reconcile what, at least to my mind, are the clear benefits of globalization and free and open trade in terms of good jobs for future generations of Americans, for our kids, which is how I think about it, with the pretty unambiguous disenchantment of working and middle class people across the developed economies, with globalization, with multilateral business. And let's be really clear, that disenchantment is both on the left and on the right now. You've got populists on both sides of the aisle who have come to believe that the global economy has left the working and middle class behind. And, I really do urge you to read Jason Smith's press releases closely. Pat Brown said it very politely, but I don't think you can read those and think big global business has a good friend in the Republican chairman of the Ways and Means Committee these days. And he represents the dominant national conservative strain of the modern Republican Party, which, like the progressive left wing of the Democratic Party, is absolutely ready to go after the US multinational corporate community. That's the environment that those of us who believe, successful, globally engaged US business is good for the country and good for the opportunity set for our children find ourselves in. And it's an important baseline to think from. It's a long way from Weinberger or Chairman Thomas, for those who remember him, or the cozy bipartisan consensus on the benefits of globalization of the Clinton years. And I think that leads to deeper questions for business leaders. Like, what would exactly happen if the bottom fell out on the international economic multilateralism that makes successful cross-border business possible? Would globally engaged multilateral business be as successful if economic populism, protectionism, and, frankly, even the anti-immigrant sentiment that often comes with all that won out politically? At least for those who, like me, believe that US M&E success is good for the country, by which I mean it's good for US employment and opportunity for our kids, blunting attacks from populists on both sides by promoting a level playing field and saying now, multinational business is paying its fair share, so stop targeting them, or at least take, corporate tax off the target list. That makes a lot of sense to me. Now, that said, I also think it's important to acknowledge, and be clear about where we are, because, a lot of people thought the global minimum tax deal was a long shot. A small number of us were asked to work on it, starting with Secretary Yellen. We got agreement internationally. And along the way, it became the exemplar in 2021 of how the US was both talking the talk and walking the walk on international economic multilateralism. For a little while, that also meant, the US had an international economic multilateral leadership initiative and an example of an international economic foreign policy that spoke to the concerns of working and middle-class people. And in some respects, that's still true, but then something else happened, which is that guilty country-by-country reform didn't become law in December 2021, or ultimately even in summer 2022. And sometimes what I think that people in the DC tax community fail to appreciate is that on the global stage, the path dependence does matter. So a major cost of waiting till 2025 to potentially reform US law and having the rest of the world sort of drag us towards Pillar 2, instead of leading the way there, which I view as a really huge loss, is this loss of a sense abroad that the US was really leading in the international economic space and the consequent ability of the US to sort of shape that space. And where does that leave us now? Well, unambiguously on sort of this Plan B trajectory, meaning that, guilty hasn't been reformed, but the rest of the world is going to put pressure on us via UTPR to move to a country-by-country system in 2025. And I think as we head towards 2025, the pressure from the enforcement rule for the US to comply with Pillar 2 by reforming guilty to a country-by-country system will keep going up. And it may be that many in the private community will, get further down the 5 stages of grief. And I hope they'll ultimately conclude that guilty country-by-country is better than dealing with UTPR. And I think the same is true for adopting a QDMTT. And I think all of that's the right answer for the US fisc, not just in terms of revenue, but also in terms of where profits are booked, but even more important for US well-being in terms of where it will mean US M&Es choose to base jobs in the US instead of abroad. And Treasury's behavioral estimates, frankly, showed all of those effects. But I also think that, it's just the right answer for the US corporate community's narrower self-interest, because I think the alternative is UTPR. And I fully acknowledge the latter depends on whether other countries enforce UTPR, and also on my belief that unlike companies facing, guilty country by country or an income inclusion rule or QDMTT, Pillar 2 UTPR payers may run risks of double taxation. That's true. But what I'm now worried about is that by 2025, what I think is a relatively small cohort of tax directors and tax lobbyists and, maybe an accounting firm too, that are actively jazzing up congressional Republicans to go on the full warpath against Pillar 2. We'll get people like Representative Smith and Representative Hearn and Senator Crapo so far down that path that if Republicans have control in 2025, maybe that can't be redirected. Because remember, as I've been alluding to, the modern Republican Party is very clear that they don't necessarily care what the people sitting in the C-suites of major US multinational corporations think. They are not your father's Republicans, or as one tax policy professional I respect says, they're not even your older brother's Republican. So if they win, this could well become real. In other words, we could actually have the tax and trade war that may be proposed with Pillar 2 retaliatory provisions shortly in the House. With then tit for tat from abroad, because you've got 50 countries around the world that aren't going to easily and suddenly collectively repeal their new corporate income tax rules because of a retaliatory rule passed by Congress. And with Republican sweep, Congress could pass a retaliatory provision, even if it turns out, as I suspect it will, that when you go above tax director level, it turns out while the C-suite might not uniformly love 15% guilty country by country, they don't actually think it's bad enough to want a tax and trade war with Europe and Asia over it. But by 2025, it may be too late. So I think we need a course correction. If we don't have it, we may have a real mess from the perspective of corporate leadership, right? C-suite people who think about the big picture about the international economic environment, and not just the question of exactly how much tax is being collected or how. And let's be clear, I mean, it's going to be complicated because in 2025 we have a tax bill that's a must-do for Congress because of the TCJA expirations, not just at the corporate level but at the individual level. So there probably will not be a presidential veto of a big bill, right? Just because of, for example, a retaliatory provision. And meanwhile, recall how organizations like the BRT and the Chamber felt about all the Trump tariffs and the tit-for-tat retaliatory environment they created. They weren't very happy about that. So I think there is a silent majority that regardless of how they feel about guilty country by country, don't can understand. We should think more broadly about the cross-border business environment on a comprehensive basis. And I hope that community speaks up. Otherwise, I think there are real risks. But I'll end where I started. I mean, Pillar 2 is happening abroad. That's a done deal. A higher degree of book tax conformity for globally engaged MNEs is happening. It's happening both through CAMT and through Pillar 2. Pillar 2's rules are pretty clearly more sensible in that regard than CAMT, which taxes all sorts of things that Danielle and Pat pointed to that are not particularly sensible to tax from a tax policy perspective. Pillar 2, unlike, creates a more level playing field for US MNEs than we've ever seen before. And the consequences for not coming into conformity with Pillar 2 are bigger risks for US MNEs than just having to pay UTPR on the one hand, or facing a 15% country by country guilty rate, or adoption of the income inclusion rule itself on the other. Thanks.
Thank you very much. We have time for a few questions. If you have a question from the audience, please put it in the Q&A box. And if anybody on the panel wants to ask Itai questions, you can put that in the chat box. So I guess I'll start. And I really appreciate you putting this in a broader perspective. So I can probably only think of narrower questions, but there are a bunch of differences between the guilty rules and the Pillar 2, including the deductions that are allowed and the not just the country by country. And I was wondering, what is it that the US has to do to conform to be consistent with the Pillar 2? Is country by country all, or are there other things? Or
country by country is enough. In other words, we recognized full well as we were negotiating Pillar 2 that Congress was not likely, that Congress was more likely to adopt much more likely to adopt a guilty country by country system than to full bore adopt an alternative set of rules that had been developed, beginning for 2 years of the Trump administration, right? To create a country by country tax that started from financial statements. And so there was a clear agreement in the political agreement that from the perspective of the rest of the world, the US simply adopting guilty on a country by country basis at a 15% rate would be sufficient. Now, that doesn't mean now that we have, a couple years that it's not worth thinking about whether or not people think, given the changes in the rest of the world, whether that's a project worth studying. Like, is the income inclusion rule a better system? I hearken back to a variety of things that people complain about with respect to GILTI, beginning with expense allocation. And, there are some people who think the income inclusion rule is better. I think a project comparing the two is worth doing. But the basic answer is, just go GILTI country by country if that's the preference.
Okay, I'll try one more question while I'm waiting for more from the audience. So I've heard people complain that the Pillar 2 could impose unintended consequences on U.S. corporations having to pay taxes to foreign governments under certain circumstances. And I presume that's if we don't adopt country by country or something of the like. So how serious is that if the U.S. doesn't adopt the conforming thing, it could be?
I think it is correct to say, right, that the way the rules are structured, the intent was to create an enforcement tool that discouraged defection from the regime, and therefore, to the extent the United States does not choose to go to a GILTI country by country system and collect, a 15% minimum tax on the Pillar 2 base domestically as well, there are absolutely risks of that. Now, I think that when you confront the choice between having a tax and trade war or similar or simply collecting more revenue for the U.S. fisc, I actually don't think that's such a complicated decision, and I don't really think it's at a very high rate either. I mean, it's not it's not a ton of money, and frankly, with respect to QDMTT, it replaces CAMT. I mean, it can, right? And it's just a better tax, but we'll see what happens.
Okay, great. Well, thank you very much. This has really been a very interesting presentation, and thank you for putting this in a broader perspective, which I think makes it very interesting to our audience and certainly to me. I want to thank all the panelists in the audience for a very interesting discussion today, and my colleagues at the Keenan-Flagler Business School at UNC for their collaboration in putting together this program, and our events team at the Urban Institute for all their help in organizing and handling the logistics, and the audience for all the questions earlier. So thank you all very much for this. And if you would please take a moment to complete the final poll for the CPE credits, and when it's finished, Haley will conclude the program. Thank you.